Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stocks looking to close out the week in the green. S&P futures pushing higher as the benchmark index looks to ink its best week since the presidential election. The strong weekly performance coming despite a sell-off in mega-cap tech stocks on Thursday, where Apple saw its biggest intraday decline since August of 2024.
Plus, Bitcoin pushing past 100,000 amid reports that President-elect Donald Trump plans to release an executive order making crypto a national priority and creating a crypto advisory council. The order may also direct government agencies to review policies on digital assets, pause litigation involving crypto, and could also include the creation of a national Bitcoin stockpile.
And the U.S. Supreme Court signaled it is likely to rule today on the law that would ban TikTok if it's not sold to a U.S. company by Sunday. Two current Biden administration officials told Bloomberg that the Sunday deadline and Martin Luther King Jr. holiday on Monday essentially pushes enforcement to the next administration, which would open the door for Trump to extend the deadline. Wall Street expects a pro-business Trump administration to boost returns in sectors like energy and financials. But what does history actually tell us about market performance under both administrations? Here with a closer look at Biden versus Trump 1.0, Yahoo Finance's Jared Blickery. Hey, Jared.
Thank you, Brad. When 2017 rolled around, a lot of people had ideas about what the Trump trade would be and would not be. Most of those ideas were wrong. So I just wanted to map out exactly how certain sectors did, and this is election day to election day, so that would be November to November, Trump won versus Biden. First up, we have tech, and tech soared 140% under Trump won, and then it was up 100% under Biden. And let me break this down in terms of the Mag 7. Now, back then, we were talking about the FANG index and the FANG members. Netflix was a part of it, but I think people are really thinking of some of the bigger names. So let's go through them. Apple is up 300%. Microsoft was up 240% under Trump won. But under Biden, Apple was only up 100%. Microsoft was up 100% as well. Now we get to Nvidia. That's another Mag 7 name that falls under the tech category. That was up 631%, which was actually less than what we saw under Biden. That was almost 1,000%. Now, next up here, we have XLY. That is consumer discretionary. There are two consumer or retail sectors, the stuff people want, which is consumer discretionary, and then the stuff people need, which is staples. So we're talking about consumer discretionary here. There are two big names under there, Amazon and Tesla. Amazon up almost 300% under Trump, and that's despite all the animosity between Bezos and Trump back in the day. And then it was up 31% under Biden, and then Tesla was up almost 1,000% under Trump, and then it was up 78% under Biden. And who knows what we're going to see in the next administration, but we have to talk about healthcare here too, because surprisingly, healthcare did a little bit better under Trump than it did under Biden. So let's move on here. We have some Biden wins. Industrials takes the cake. And now we're talking about some of the cyclicals here. I'm going to get to financials and also energy. And to do that, we really have to take a look at the 10-year T-note yield. This goes back to the 1980s. And what I want everybody to notice is it goes from the upper left to the lower right here, all the way down. But we have recently, since the pandemic, broken out. And these higher interest rates are forcing us into another environment that we haven't seen in a long time, where things like industrials can outperform. And they have done that at certain times. So I'm going to go back to our analysis here and just kind of go through the remaining Biden tickers. Biden won industrials by, let's see here, we got XLI up about 50% under Biden versus 30% under Trump. We can also take a look at financials. For all the talk about deregulations, financials actually did a lot better under Biden, and that gets back to the interest rate situation. The 10-year T-note yield and widening yield curves at various times, that has given financials an edge. And you could say we're kind of getting back to normal business after 10, 20 years of preternaturally low interest rates. I'm going to round this discussion out with energy, and you're going to see this is the one outlier. Energy actually dropped 56% under Trump, and it gained 205% under Biden. Now, that was a huge flip from what people thought when we came into the first Trump administration. And I'm also going to tell you that TAN, this is a solar ETF, and I love this. It was up 267% under Trump, and it was down 40% under Biden. So not everything kind of works out the way we might think heading into these things. I think heading into the Trump inauguration, what's really providing the biggest tailwind for stocks is that huge CPI report that we saw, where the inflation rate came in lower than expected. So, putting it all together, I think we got quite a show for us for 2025.
You certainly do. It sounds like it's shaping up like that. Jared, thanks so much. Well, President-elect Trump has promised a slew of executive orders on the first day of his presidency on wide-ranging domestic and international policy issues. Very own Rick Newman is here with more. And Rick, I think the big question for investors right now is, realistically, from your perspective, where should we expect to see the action on day one?
Oh, there's going to be action everywhere on day one. It's going to be hard to keep track of. I think markets might take days or weeks to digest it all. But I mean, some of the things I think we are pretty clear are coming. There's going to be the beginning of whatever Trump's trade policy is. We're going to see some hint of how far he's going to go on tariffs. I mean, the big question is he going to do everything he says he's going to do, or is it going to be more mild than that? We're going to see something on immigration for sure. I mean, this is one of the things Trump campaigned hard on. So he's probably going to go harder than Biden has gone on cutting down migrants coming across the southwest border. And then probably a lot on energy. Trump's energy policy, as we know, is drill, baby, drill. He wants to do whatever he can to generate more oil and natural gas production. So I think we're going to see something there. That does not necessarily mean we're going to get more production. I would caution anybody who's thinking that we're going to get all this energy flooding into the market. That's not really what energy firms want to do. They like oil prices high, they like where they are. They'd like to see them go higher. More energy means lower prices. So I don't think that they're necessarily going to do everything Trump wants, but he's definitely going to be good for the energy industry.
Rick, while we have you, you also think that Trump Treasury Secretary nominee Scott Bessent's 333 plan will turn out more like a 260 plan. Explain it, and why is that?
Well, I wonder if people are even aware of Scott Bessent's 333 plan, but I just went through the 3 threes, if you will, and I looked at what forecasts are for these three areas. So just very briefly, he wants 3% GDP growth. Probably not. Most forecasts are for GDP growth over the next 10 years of 1.5, 1.6% per year. I mean, we're going to be lucky to get 2%. He wants 3 million additional barrels of U.S. oil production. The forecasts are we're at about 13 million barrels per day, and the forecasts are we're probably just going to stay around there. And then the one that's really not going to happen, he wants to reduce annual fiscal deficits to 3% of GDP. Well, they are now at 7% of GDP, and they're probably going to go higher, not lower. I mean, Trump wants these tax cuts that are potentially going to add $5 trillion to the national debt. It's more likely that annual deficits are going to go closer to 10% of GDP than to 3% of GDP. So Scott Bessent has admirable goals, and if we reach them, it'll be terrific. I just don't think there's a very good chance we will reach those goals.
Rick, I'm curious what you made of the hearing yesterday. Not necessarily much that was too surprising. It was more just an elaboration on some of the plans and some of the thought process that we have heard from Scott Bessent. But just in terms of what the market seems to be hoping for versus what will be, and to use the word realistic again, and the priority here for Bessent as Treasury Secretary, how do you think that stacks up?
Well, he's one of Trump's less controversial cabinet nominees. He's going to get confirmed. He is going to be the Treasury Secretary. I think markets are generally comfortable with him, but markets disagree with some of the things Scott Bessent has been saying. For example, some senators asked him, "Well, these Trump tariffs, aren't they going to raise prices?" And he said, "No, I don't see any reason why tariffs should raise prices." And he explained that, well, the dollar will probably strengthen, and that will add new purchasing power that will offset additional costs. That is just not what markets think is going to happen. Markets think that if the Trump tariffs go into effect, more or less as Trump said they will, we will have higher prices, and that will be an inflationary problem. And that's one of the reasons we've been talking about, the 10-year Treasury. has been going up while short-term rates have been going down. That's one of the reasons why markets anticipate higher inflation under Trump. So he's not saying, that he's not squared up with markets on that, but he might also be kind of hinting that maybe Trump won't be as aggressive on tariffs as he has said while campaigning.
Rick, thanks so much. Really appreciate it here. We're going to be watching closely. And of course, a programming note here, Yahoo Finance will have special coverage of President-elect Trump's inauguration on Monday, January 20th, starting at 9:30 a.m. Eastern Time. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to check in on ticker symbol AAPL, Apple. Edging higher after its worst day since August, following reports of weak iPhone sales in China. Market research firm Canalys, suggesting Apple fell to third place for smartphone sales in China in 2024. That's behind Huawei and Vivo. Apple is set to report quarterly results on January 30th here. We're taking a look at shares, though, up by about 1.3%. This kind of runs in synonym with some of the counterpoint research that we had seen to start off the year as well, just suggesting the share gains that we had seen by some of the other China homegrown and Asia Pacific homegrown smartphone manufacturers.
Yeah, exactly. When you take a look at the trends inside China, a bit worrisome. We've seen that reflected in shares of Apple now for the last several trading days, last several weeks. When you take a look at some of that underperformance, especially relative to some of its larger, not larger in comparison to Apple, but other large tech giants as well. So again, we talked about this underperformance here. Certainly the stock taking a pretty dramatic leg lower yesterday. You can see the 5-day chart up on your screen. You're looking at losses of just about 6%. I think going forward, lots of talk about tariffs. Now, Apple largely expected to be exempt potentially here from any tariffs from the Trump administration. But we have seen that casting a bit of a shadow and overhang here on Apple and some of the other tech giants as we talk curbs in terms of what is being done with it inside the chip sector. So certainly the larger tech names do have some to worry about. I think overall, when you take a look at the latest data and the research that's out from so many analysts on the street, including Bush's Dan Ives, they're still very optimistic on big tech under Trump, talking about lighter regulation and how that is going to be beneficial here in the longer term. But I think one of the constants that we've heard over the last several weeks, and really going back to the election ever since President-elect Donald Trump was elected, was one of the big concerns on the street is the unpredictability, that nature here under President-elect Trump. And we're seeing that reflected in the markets. And that's, of course, expected to increase some of that volatility then going forward. Yeah,
and it also comes back to how much reliance there still is within the Apple trade on China as part of its growth narrative going forward from here too, even beyond smartphones. And smartphones are really just the stickiest portion of the ecosystem. That is perhaps the hub that the rest of the wearables and perhaps even the MacBook products, those are just spokes on top of how you would look for the consumer to say, all right, I have this one device that is central to my entire electronic user experience, and now I want to make sure that all of that is interconnected. And so some of the share gains that we've seen, and even coming into the start of this year, we had known from some of the IDC research that there was even more of a growing appetite for some Android OS products within China, and that could continue to spell out a headwind on top of whatever type of geopolitical implications there are as a tit-for-tat tariff or trade war could be brewing in the background as well.
All right, let's move on to another big story here this morning, and that's Novo Nordisk's Ozempic and Wegovy will be targeted in the next round of Medicare drug price negotiations. That's according to officials. Now, the blockbuster weight loss drugs are among 15 medications on this list, which also includes treatments for cancer and treatments for asthma. Prices negotiated in the second round of talks will take effect in 2027. Drug makers have until February 28th to decide if they will participate in these talks. So a lot to unpack here. And we have Novo Nordisk, the share price up on the screen right now. So let's start there. You're looking at losses of just about 4%. Why? Well, lots of discussion here this morning on ultimately what this could mean for Novo Nordisk's bottom line if, in fact, this were to go through. Now, we know the last round of the IRA negotiations gave Medicare an average 22% price reduction for the drugs that had been on this list. So again, that could potentially really have an impact to Novo Nordisk's bottom line here going forward. But of course, lots of questions, just ultimately how this all plays out, what happens under the Trump administration, whether or not they're going to do away with the IRA, whether or not these IRA negotiations are going to follow through, what regulators are going to enforce. So again, this isn't set to take place or isn't set to go into effect for a couple of years. And there's a lot of questions out in the street as to how realistic or how likely this is going to be here.
Yeah, one of the big numbers that stuck out to me, and Zavient is one of the firms out there that was really doing some research around the cost implication and healthcare costs tied to GLP-1 medications, healthcare costs tied to the obesity, or obesity as well in general, exceeding $260 billion annually, and the corporate side of this as well, and how they're looking for, because it's the negotiations that take place, but also how corporations, typically for any employer-sponsored healthcare plans, where they are also picking up the cost here too. And so some of those healthcare costs that the corporations are focused in on is this overall figure at that $260 billion annually tied to obesity. And of course, we know for some of the weight loss drugs that have come forward, there are a lot of different measures that are coming forward in the future here, trying to make sure that it's everything from an oral pill all the way to what's already existing on the market right now and any types of treatments. And I think even as we get into, and even as we go further into the throes of 2025, this is going to be a continued grappling point. How much does the corporation pay in the employer-sponsored healthcare plan versus what the government is actually going to be accounting for as well? And you have an incoming administration that has, not been cheerful of weight loss drugs to this point as well. So.
Yeah, lots of questions about ultimately, we'll see what happens with IXIC and all that going forward. But again, these drugs accounting for $41 billion in annual Medicare spending, about a third of Part D drugs dispensed at the pharmacy again. So putting that into context just in terms of how big of an impact this could potentially have.
Absolutely. We're also learning more details about Chinese hackers' breach of the U.S. Treasury. State-sponsored agents gained access to Secretary Janet Yellen's computer and thousands of unclassified files during the attack last fall, according to Bloomberg. The agency disclosed the scope of the breach to lawmakers in closed-door briefings this week. Details of the meetings were first reported by Politico.
In addition to Secretary Yellen, officials saying that the hackers also targeted files belonging to other top members of the Treasury, the Committee on Foreign Investment in the U.S., and the Office of Foreign Assets Control. In total, 419 Treasury computers and over 3,000 files were accessed, that's according to officials. Only unclassified information was compromised during the breach. Chinese officials have denied any involvement in the cyber attacks, and a spokesperson last month calling the claims that Beijing was behind the hack, quote, unwarranted and groundless. Coming up on a morning brief, we're going to count you down to the opening bell on Wall Street, with the S&P headed for its best week since the election. You're looking at gains. It looks like all three of the major averages on track to open the day in the green. Plus, we break down the latest earnings coming out from regional banks. And we'll look at some of today's biggest stock movers as the former CEO returned to the company of Bumble. We've got that for you and much more coming up later this hour.
Regional banks reporting fourth quarter better than expected results this morning. Citizens Financial more than doubling its profit as non-interest income rose. Truist getting a boost from stronger investment banking, and Huntington Bank shares reporting record fee income. Joining us now, we've got Chris McGrady, who is the KBW Managing Director and Head of U.S. Bank Research. Chris, good to have you here with us. So how are you looking at the regional banks right now?
Great. Thanks for having me on. We are market weight U.S. banks, and that's a stance we've had for the better part of 3 years. But we do see pockets of significant value within the group. At the biggest banks, they're benefiting from a capital markets rebound and M&A activity, and you saw that this week with the largest banks. And we think the prospects of deregulation has the potential to move multiples up on the mid-cap stocks, which have been punitively hit because of regulation.
Chris, how much of that has, I guess the best way to ask this is, when you think about what is likely versus what some of the hope out there is on the street and what has already started to maybe be priced in to this sector, where does that stand?
From an earnings perspective, the yield curve is steepening, right? There's no question that the curve is positively sloped after having the longest inversion in 45 years. So positive sloping curve is better for bank fundamentals, and we're seeing that play through in the fourth quarter results that we're seeing this week. Margins are a little bit better. Net interest income is not growing significantly, but it's not shrinking either. And so net interest income, which is the biggest driver of revenues, is moving higher. That's on the fundamentals. On the regulatory front, we're already starting to see changes. We've seen there's changes at the Fed. There's going to be changes at the FDIC, and I think what's really notable is M&A activity is coming back, and it's getting approved. Deals are getting approved quicker. We had 3 deals approved in the last 2 weeks, on time to earlier than expected, and that's a huge boost to sentiment right now.
How big of a catalyst do you see that being, specifically the deal making, the deal activity part of it being for the sector?
Well, it's a big deal. Like on average, you see about 4% of the industry consolidate every year. So that's a couple hundred bank mergers. Now, the past couple of years have been more subdued because interest rates have been going higher. Loan marks on the balance sheets have prohibited some of the actions from happening. But as we stand, M&A activity is one of the better ways and the easiest ways to grow earnings per share for the banking sector. So if regulation begins to move, not necessarily entirely easy, but just more towards the middle, you're going to start to see more activity, and that's a source of earnings growth.
Chris, I wonder what you're seeing in the read-through for the state of the consumer as it is kind of suggested, at least in the results, of some of the regional banks right now.
Consumers in great shape, right? We've seen very little credit surprises, not only in fourth quarter results, but throughout 2024. If you were to ask me a year ago, would credit be higher or lower than what it's actually coming in, I would have said over. And I think it shows that the underwriting in the banking system has gotten a lot better since the financial crisis 15 years ago. And also a lot of the credit risk has been regulated out of the banks, particular consumer. That's moved to the shadow non-traditional banks. But in general, the consumer's in great shape, and corporations are doing pretty well too.
So, Chris, when you take a look at the results that we got out, and I'm just naming all these, I know they don't all fall in your coverage, but Citizens Bank, that stock falling on lower guidance here. PNC's weak revenue outlook was an issue here. M&T's guidance also didn't really necessarily impress the street. Where's that disconnect just in terms of why we should be so encouraged, yet some of these numbers, some of these outlooks here for 2025 not necessarily living up to the street's expectations?
So the banks have had a big move since the election, right? The initial knee jerk to the banks was up 13% after the November election. Now, what happened over the next 8 weeks is the regional banks, the small and mid-cap banks, which need the yield curve, those banks fully retraced those gains. And really, it was the sell-off in the long end going higher in terms of rates that really put a damper on the momentum for the regional banks. But the largest banks have held on to some of the gains, right? They've had the capital markets play. So in general, we recommend having a barbelled approach to the banks, right? You want to have banks that'll do well in a higher for longer scenario, and you want to have banks that will over time benefit from lower rates, because most bank balance sheets want lower rates. But in general, we've seen a lot of volatility. We saw the Fed, the mid-December, more hawkish cut, I would say. And then this last week, we saw a pretty good jobs number, which which also put yields higher. And then more recently, you saw inflation come in a little bit softer. So the group is very much a macro trade. And so we got to pay a lot of close attention to rates and to inflation.
And just lastly, while we have you here, Chris, when you think about the regulatory look at banks over the past few years, especially as related to Basel, which many of the banks are pushing back on now, with the incoming administration and them also seeming to support deregulation or at least a pullback on the capital requirements that banks must have, what does that trickle through mean to the regional banks as well?
Right. It's a great question. For the largest banks, Basel III becoming capital neutral is a win, right? Instead of building extra capital, these largest banks are going to be able to return more capital to shareholders. And that's a mid to high single digit earnings upside scenario for the largest banks. Now, for the mid-cap banks, you're not going to see as big of a lift in the earnings projections, but you will see, I believe, an expansion in their earnings multiples, because the fear has been for the past several years that regulation would get pushed down to the smaller banks. And so investors were a little bit more nervous about putting a multiple on that if they thought the earnings were too high. If that gets unwound, I think that's where you're going to see multiple expansion.
All right, Chris, always great to have you. Thanks so much for taking the time to join us here this morning.
Great. Thank you.
We'll be right back with the opening bell. We've got the opening bell on Wall Street as we kick off the final trading day of the week, and it's certainly been one to remember here for the markets. We're looking at gains almost across the board when you take a look at the last 5 trading days and some of the action that we've seen. A lot of that on the back of the CPI print coming in just below forecast expectations. The fact that inflationary pressures seem to be easing, that of course is adding to some of this risk on sentiment. Also strong earnings from some of the largest banks out there. That's also helping to boost some of that sentiment as well. So here we are, the final trading day of the week. You're looking at the S&P starting the day to the upside here with the move here just shy of 6,000. You've got the Dow also pushing to the upside as well, up just about 0.7%. That's good for about a 300-point gain. You also have the Nasdaq in positive territory here this morning. You're looking at gains there. Let's take a look at the S&P over the last 5 trading days. You're looking at the best week actually for the S&P that we've seen going all the way back to election week. So that's really putting in perspective some of that risk on mentality that we've seen playing out on Wall Street here this week. Let's take a look at the sector action as we try to pull it up on our screen. We'll see on an intraday, let's go to the intraday basis here. You're looking at the tech sector up just about 1.6%. You got communications up 1.2%. Those two leading the action here this morning. Utilities and energy lagging just a bit on a 5-day basis. When you take a look at that, not too big of a different picture here. You got materials and real estate actually leading the way. Materials up just about 6% over the last 5 trading days. You got consumer staples, though, still holding on to gains up just 0.9%. Let's kick it over to Yahoo Finance's Jared Blickery for a closer look at some of the movement that we're seeing. Jared.
Thank you, Shauna. I think it is instructive that we are indeed having the best week since the election, and that just speaks as to the deck that was cleared yesterday by CPI, better than feared. So let's take this to a 1-year chart, and I'll just show you what's going on with the S&P. You can see still camped out very close to record highs here. We did have a little bit of a dip below this support level, and that was actually a healthy sign because we popped right back above. And so now we're off to the races, and wouldn't be a stretch to think that we could actually see record highs within a few days, just given the momentum that we have. Got to talk about small caps. Russell 2000 is up each day this week, and let's take a look at the 5-day total, up 3.5%. And I think it was interesting yesterday that both the Russell 2000 and the S&P 500 equal weight, not the normal market cap weight that we usually talk about, but the equal weight, those were in the green while everything else, the majors, were in the red. And this also speaks to the situation that we have with the 10-year T-note yield. I was just focusing on that with respect to sector action, but let me put a 3-month chart in and we can see how this the trend was broken here. So that trend line, importantly, has been broken. We are off of these highs. We've been down for a few days, and that is just a relief valve, and that was kind of triggered and aided and abetted by that CPI report yesterday. We have the U.S. dollar index just ticking up a little tiny bit, but nothing to worry about too much there. I'm going to go to some more sector action, but I just want to say that the AAII investor survey that comes out, it came out the most bearish since November, and that's actually pretty constructive for what we're looking at here. I don't think I have control of the interactive anymore, so I'll just kind of wrap things up with the sector action there. It looks like a day that we are in favor of the Mag 7. You can see all 3 of those sectors leading behind me, XLK, XLC, XLY. So we'll have to see if it's a day of big gains for the big generals here.
All right, Jared, we're going to get that control back for you there.
Thank you.
Appreciate it. It's time now for today's strategy session. One of last year's underperformers may be poised for a comeback. Since early 2023, the S&P 500 healthcare index has risen just 4%, while the S&P 500 surged 52%. Our next guest says investors may be overlooking the long-term potential of healthcare stocks. Joining us now to break it all down, we've got Stephanie Aliaga, who is the JP Morgan Asset Management Global Market Strategist. Great to have you back in studio with us.
Thanks for having me, Brad.
Okay, so let's talk about this opportunity that you're seeing in healthcare. Banking on a bounce back, it seems like.
Banking is on a bounce back for both the micro and the macro. This week posted really strong reports, particularly in profitability. That's a part of the market on financials, that is benefiting from a lot of the kind of macro tailwinds on deregulation, but also a soft landing. Mm-hmm. And it's an area of the market that hasn't performed or hasn't kept up with performance over the last year. I think some similar things can be said for healthcare. Yeah. Healthcare is massively underperformed. I think a big theme for us this year when rebalancing portfolios is looking where expectations are relative to the kind of potential and earnings delivery expected. Healthcare is expected to see a solid rebound. We're coming out of the cost pressures mm-hmm. that much of the industry really faced coming out of the pandemic. And then you also have these really promising secular tailwinds that have helped AI, but are also prevalent in healthcare, right? An industry that is ripe for innovation, ripe for M&A and partnerships this coming year, and is also one that is still facing this boost when it comes to GLP-1 and the focus on specialty drugs.
Where are you seeing the opportunity, and not specific stocks, but within healthcare? Is it the pharma side? Is it the insurance side? Where are you seeing that? When you talk about pipeline and what's ripe for growth right now, where are you seeing those tailwinds?
I think med tech and particularly in parts of pharma also seem to benefit, particularly ahead of the upcoming patent cycle. Now, some parts of the healthcare industry will absolutely continue to face this policy overhang just because we're not really sure yet what this next administration is going to do, particularly on drug pricing. But it seems like the sentiment at the JP Morgan Healthcare Conference that just wrapped up is one of cautious optimism. It seems like regardless of what we see, it's probably going to be something better than the regulatory environment that the healthcare industry at large has really lived in the last many years.
What does this all mean for pricing? It seems like there's a pricing battle brewing. We know the outgoing administration certainly made that one of the pillars of its kind of checklist, but for the incoming administration, do we have any clear vision on what they would like to do on pricing, and then what that means for some of the largest healthcare players as well right now?
Unfortunately, there's a lot of uncertainty still. I think different people in the kind of incoming Trump administration have said different things. I think there is absolutely a bipartisan support for lowering the drug prices, but then you also have to balance that with the incentives that these companies have to continue to push the bar forward when it comes to innovation, particularly ahead of the upcoming patent cycle.
Stephanie, when you take a look at the more macro picture right now, obviously, when it comes to the incoming administration, lots of talk also about what the Fed is going to do, how some of these policies that we could see put in place from Trump, how that could affect maybe what the Fed does when it comes to some of those inflationary concerns. How worried are you that we aren't potentially going to see the Fed maybe cut as many times as the market is expecting?
One of the analogies that we've used in our outlook is one of this kind of fog of uncertainty around the impacts that new policy will have on growth and inflation. It's an analogy Powell used too. What do you do when you're driving through fog? You just move a little bit slower. That doesn't mean you're completely diverting and making any dramatic changes in the path forward, but the Fed is gonna move slower just until we get greater clarity on the kind of policy change we're going to see. And whatever policy change we see, it's going to take time for that to impact the economy and inflation. Mm-hmm. So what we think is the more powerful force on both the economy and inflation are the same things that were driving those two last year, right? Mm-hmm. We have an economy that is still growing at an above trend rate of growth, but it's gradually cooling, still has that gradual weight of monetary policy. And then as the recent CPI report showed, it looks like disinflation is still very much on track, particularly in the stickiest, biggest components of CPI core services that matter so much. Once the fog fades a little bit, we do think the Fed will feel comfortable in easing policy in the back half of this year.
A lot of people might be out there wondering and just asking themselves, well, what do I do with my Mag 7 stocks in the fog?
Yes. Look, I think in the fog, right, you're checking your exposure. Yeah. You're checking your headlights, making sure they work, your brakes, right? And I think when it comes to the Mag 7, investors need to check their exposure, the concentration risk. And look, concentration can be in really quality companies, but even if a really quality company wobbles, right, we all feel this earthquake. Is that the kind of risk that you want in portfolios this year? Particularly given that now for the Mag 7, you're facing elevated valuations, really, really lofty expectations for them to beat. They may beat it, but they will likely not be rewarded as much as they had the last few years. So investors should lean into diversification, not just for risk management, but also because there's a lot more quality, a lot more improving fundamentals on the investment menu this year than there were in the last 2 years.
All right, Stephanie, great stuff. Thanks so much.
Thanks so much for having me.
Streaming companies finally turning a profit, but can that momentum last? We've got much more for you coming up on Morning Brief.
Netflix will kick off media earnings next week after the company pulled in $6.9 billion worth of profits in the first 9 months of last year. But the legacy giants also enjoyed streaming profits of their own, with some reaching profitability for the very first time. A big question for analysts in 2025 is whether or not that momentum can last. Yahoo Finance's Alexandra Canal joins us now with more on what lies ahead. Thank God it was billions of dollars in profits and not millions, because otherwise you'd have some very angry investors out there.
Well, it's interesting because when you think about the trajectory of a lot of these companies, right? Netflix obviously has been the biggie in terms of profitability. Like you mentioned, pulling in the bulk of that, $6.9 billion. And that doesn't even include the fourth quarter. Netflix has been at this a long time. It's a pure play streaming company. It's judged differently compared to some of those other legacy players out there. But 2024 was the first year that we really started to see that momentum shift. So collectively, including Netflix, along with those top legacy companies, so think Disney, Paramount, Warner Brothers Discovery, and Comcast, they delivered a profit for the very first time. So I did the math here. And when you factor in all of those companies' results, we saw $5.9 billion worth of profits in the first 9 months of 2024, compared to a loss of $142 million in the same period last year. So this is significant. We saw some players reach profitability for the very first time, like Disney and Paramount. Warner Brothers Discovery had a pretty choppy year throughout the course of 2024, but ended it in the green. And then Peacock, those losses are still there, but they were able to narrow that pretty significantly. So there's a few reasons why we were able to achieve this. One, we've reached a critical mass of subscribers. We've continued to add subs, which is incredibly important. Two, we have shrinking content budgets across the board. So at the peak of the streaming wars, a lot of those companies were spending a ton of money, but that led to a quality issue. And to that point, because those content budgets have shrunk, they are now focusing more on quality over quantity projects. And then finally, bundling. That's something that more competitors are doing, just kind of teaming up with each other to try and increase engagement. Analysts say that's going to be critical for the years ahead, especially if these companies want to compete or at least be a competitive option to Netflix. So a lot riding on streaming success, but analysts have consistently said that for these legacy giants, they not only need to deliver profits, they need to deliver fast growing profits to try and offset those major declines that we've seen on the linear television side.
All right, Allie, great stuff. Thanks so much. Let's drill down now into Netflix specifically, because Netflix here on the move ahead of its fourth quarter results. Those are due out on Tuesday after the closing bell. You're looking at some gains today here, up just about 1.5%. We want to bring in Geetha Ranganathan, Bloomberg Intelligence Senior Media Analyst. Geetha, it's great to have you back here on Yahoo Finance. Talk to us about what we could expect here from the fourth quarter. High expectations going into this. We certainly have seen momentum play out here at Netflix. Are they going to meet that higher bar?
Thank you, Shana. Good morning, and it's great to be here. Yeah, absolutely. I mean, very high expectations going into this quarter. And if you just kind of look at it, it's really the perfect setup for Netflix. So I think, in terms of content, this has probably been one of their strongest quarters ever. Typically, fourth quarters tend to do really, really well. But really, I think this time around, sports is dominating the narrative. And it's going to be really interesting to see how that shapes the future of Netflix. So you had that big Mike Tyson-Jake Paul fight. You had the two Christmas Day games, the NFL Christmas Day games. So big sporting events there. And then we're going to see continued momentum from that sports with WWE broadcasts, kind of starting on Netflix in January. So this is really the big shift, I think, that we're going to see this quarter. And so that is really definitely going to drive subscriber momentum for Netflix in a big way. So we're expecting well over 10 million subscriber additions. And the reason this quarter is so important, Shauna, is because this is the very last time in Netflix's history that they will be reporting subscriber numbers. So analysts are going to have to find some new metrics to kind of start gauging them on.
Geetha, it's great to get some of those subscriber projections. And I wonder if those projections are based off of the performances that we've seen from the NFL games, from Tyson-Paul fights. When those are really kind of one-offs. You're not going to get a Beyonce performing a halftime performance again. You're not going to get Mike Tyson to step back in the ring again, most likely here. So where do you see some of those figures normalizing, and then perhaps that setting in a baseline for the expectations around that subscriber growth?
Yeah, that's a great point, Brad. So sports, when you have these types of one-off events, obviously they are great subscriber acquisition tools, but then you are talking about subscriber retention. And I think that's where the WWE content comes in, because this is year-round programming. You look at the NFL, you look at the one-off games, yeah, there is a season, football season or basketball season, and then it kind of fades away. So we've had subscribers kind of joining the service and churning out of the service. But when you have, year-round programming, it turns into a very sticky type of content, and that's exactly what they did with the WWE. And there is some speculation that they're going to do some similar deals with Formula One, with UFC, which again is going to give them year-round content to keep those subscribers. And I think we're going to continue to see more deals from them in the future. Of course, have those big splashy events, but then also have programming, almost shoulder content that can support those subscribers and give them enough to come back to the service day in and day out.
Geetha, does that pave the way for further price increases?
So yes, so we've been expecting a price increase in the US market for quite a while now. So Shauna, believe it or not, it's been 3 years since Netflix actually raised the prices on its standard plan, which costs $15.50, which is a very long time, because typically their pricing frequency has been every 15 months or so. So they're definitely long overdue. And I think what we're going to see when they report results next week is that there is probably going to be a slight downward revision in terms of their revenue guidance for 2025. And I say that only because of the strengthening dollar. And that does tend to play a big role for Netflix's revenue projections. So I think they'll temper those revenue growth projections of 11 to 13% very slightly. But I think the way that they kind of offset that is with a big price increase. That could happen anytime this year. So we think that could almost potentially add, $1 billion in incremental revenue.
When you think about some of the key content releases that are still to come this year and how that compares to what they've spent to build that content, either via licensing or via original productions, do you think that that will elicit a broader kind of slowdown in some of that spending, or the rate of spending that Netflix puts towards those productions?
Yeah, the rate of spending is definitely going to be a little bit lower than the rate of revenue growth. And that's really what we're looking for as we kind of move into this next big phase of, Netflix's growth, which is not going to be so much on the subscriber side, but which is going to be more profit growth, as Ali was kind of mentioning. So the two big numbers that we are kind of putting forth for Netflix as we gauge its performance in the coming quarters and the coming year is really going to be, can it maintain its revenue growth momentum of over 10%? And we think it definitely can over the next few years as advertising becomes a bigger portion. And then, of course, you have the operating profit, which we are projecting about 20% operating income growth into 2025. And again, I think that can be sustained. A lot of that, of course, Brad, is going to come down to content costs and how they manage those costs. And I think, yes, they are going to have to grow costs to a certain extent just in order to provide the content to keep, new subscribers coming, to keep existing subscribers from leaving. But we still think that it's going to be pretty rational, and it's going to be within that $18 billion envelope.
Great evaluation as always. Geetha, thank you so much for taking the time here. Appreciate it.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, we got to take a look at mining companies Rio Tinto and Glencore. They have held early stage talks about merging their businesses, according to Bloomberg. The discussions reportedly took place late last year, but are not currently active. A possible merger would rank as the largest ever mining deal, which would likely come under some regulatory scrutiny.
Plus, Bumble founder and executive chair Whitney Wolfe Herd is returning to the dating app company. She's returning as CEO. That's effective mid-March. Now, Wolfe Herd succeeding Lydian Jones, who is resigning from her role for personal reasons. Jones will continue as CEO until that transition. Now, Bumble adding in a statement that it expects fourth quarter total revenue and Bumble app revenue above the midpoints of the previously provided outlook ranges. Now, that report is expected to come in March. Wolfe Herd's returns comes a year after she announced her departure as CEO. So she's back after just 1 year.
She's back, and we call that a Bumble boomerang. JetBlue and Southwest cut to underperform from neutral at Bank of America ahead of earnings. The analysts citing the stock's high valuation without as much exposure to some of the strongest industry trends right now in corporate, premium, and international routes. Both airlines are actually reporting quarterly results the last week of January. Can't wait for those. Let's stay in the skies, though. Why don't we?
Stay in the skies. SpaceX's Starship rocket exploded during its 7th test flight on Thursday. We're looking at various cell phone footage captured by a group of people visiting the Turks and Caicos Islands. You can see debris from the rocket there falling from the sky. Now, SpaceX saying that any of that debris would have fallen into a designated hazard zone. They're asking people to contact local authorities or the SpaceX debris hotline if you think you identified a piece of debris. The FAA alerted to some flight delays due to this debris. Now, the Starship rocket successfully lifting off from a base in Texas on Thursday afternoon. Recording and transmitting from the rocket was lost about 8.5 minutes into the flight. Elon Musk's SpaceX saying that the initial data indicated a fire had developed, leading to the explosion.
The loss came just hours after Blue Origin successfully launched its New Glenn rocket into orbit during its debut flight. The Bezos-backed space company taking a step closer in its challenge to Musk's business. SpaceX did manage to successfully land the Starship's booster. You can see video of the booster aligning with the tower and coming into land. The company did not attempt the booster catch on the 6th test flight back in November, citing some of the tech issues. SpaceX is in competition with the likes of Blue Origin, Rocket Lab, Virgin Galactic, and United Launch Alliance, but for different reasons in some cases.
Well, that does it for this morning's brief, but keep it right here. We've got Catalyst coming up next. Welcome to Catalyst. I'm Shauna Smith. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour. First up, we break down how investors are positioning for a new administration and which trades to watch under President-elect Trump. Plus, Bitcoin back above 100,000 on renewed optimism for the crypto policy. We break down what to watch for next week. And a potential TikTok ruling could come as soon as today, with a ban set to take effect over the weekend. Will the Trump administration intervene and extend negotiations? Let's take a look at some of the market headlines to start the hour here. Taking a look at the major averages, again, a winning week here for Wall Street. You got all 3 of the major averages closing out the trading week in the green right now. You've got Nasdaq leading the way for today. It's up just about 1.4%. You got this risk-on mentality back in the markets here this morning. You've got the S&P up just about 0.8%. The S&P is actually on track for the best week that we have seen going back to the election. You've got the Dow up here this morning just about 338. Flipping over to the bond market, lots of jitters surrounding the jump that we saw in yields. That has very much been the story over the last several weeks. But taking a look at this week and the trading action that we've seen following that softer CPI print, we've seen a bit of a reversal in yields, still well off the highs, a bit of a move to the upside here this morning, but not a huge bump here. You got the 10-year yield still right around that 4.6 level at 461. Let's flip over to the crypto industry and take a look at Bitcoin. You got Bitcoin back above 100,000, continuing that momentum that we were talking about yesterday. And here it's currently trading right above 103,000. Well, Treasury yields pulling back from that 14-month high after encouraging inflation data this week. But uncertainty about the incoming Trump administration's monetary policy, that could actually threaten more volatility. Here to discuss some of that near-term weakness and if it could present some buying opportunities. For that, we want to bring in Max Kettner. He is HSBC's chief multi-asset strategist. Max, just your first thought on rates, the dramatic decline really that we've seen ever since we got that print coming out on inflation earlier this week. Have we seen a peak in yields? Is that fair to say?
Yeah, I think that's fair to say, because when we look at the last couple of days, also when we look at the testimony from the incoming Treasury Secretary from Scott Bessent, I think it's been very, very sort of clear that policy changes will come incremental, will come gradual, that, for example, also terming out maturities in Treasury issuance, that is not going to come with a big bang, but it's actually going to be a lot more gradual. That should also reduce some concerns around this so-called term premium, so around the compensation for holding longer maturity bonds. And obviously, the data this week, not only the headline data, not only what we're seeing on our screens, but also beneath the surface when we look at underlying inflation measures, things like this, the Fed's preferred or now preferred gauge, things like super core inflation, so services inflation without housing, it's clearly slowed down. So all in all, I think it's going to be really, really hard to sell a picture where you're saying, oh yeah, the 10-year has to be pushing above 5% now in the next couple of months. I think the peak is in then.
So Max, when we talk about what investors should do, some of that risk-on mentality maybe does present some sort of buying opportunity. How should they be weighing or evaluating what makes the most sense at this juncture?
Yeah, it's an interesting question because we find ourselves, if anything, probably in an environment where you kind of want to be buying everything. So the picture that we've laid out really for the first half of this year is a sort of an extreme Goldilocks scenario where it's going to be really tricky to actually find an asset class that you want to be bearish on. Not what you want to buy, but actually what you want to fund it with, what you want to sell. Because now, of course, we're starting with yields on a much higher starting point. We've got a terminal rate for the Fed price that is more than 100 basis points higher compared to where we were in August and September during that growth scare last year. So obviously, yields are much more attractive. The starting point is a completely different one. But equally so, when we look at equities, the reporting season, the fourth quarter reporting season now, let's be honest, when we look at consensus expectations, consensus are saying almost all of the sectors are going to report a quarterly decline in earnings, not an increase, a decline in earnings. So we're once again faced with very, very low consensus expectations that should help equities as well. And, better earnings plus yields a bit down. That, of course, is really good also for credit. It's really good for high yield credit as well. So honestly, like we're at the point now where it's so Goldilocks that it's going to be really tough, not really looking for something that you want to buy, but rather what you want to sell.
Okay, Max, stick with me here. We need to get to some breaking news on TikTok, but we'd love to get back to you here in just a few minutes. We have some breaking news on TikTok. The Supreme Court upholding a law that threatens the U.S. a TikTok shutdown here in the U.S. Now, that ruling is set to take effect on Sunday. The ruling here saying that free speech rights must yield to concerns that the Chinese control of the app creates a national security risk. Now, this was a unanimous vote. The High Court saying today that Congress acted constitutionally when it did require ByteDance to sell the video sharing app by January 19th or face a ban. Now, this decision, of course, opening some questions just about what ultimately happens here for TikTok. Of course, you have the changing administrations. The incoming Trump administration, President-elect Trump has been supportive of TikTok as of late. He also mentioned the fact he just held a call with President Xi Jinping of China just minutes ago, saying that TikTok actually was discussed during their conversation here this morning. So let's talk about what is next here and the implications of this ruling. For that, we want to bring in Alan Rosenstein. He's Associate Professor of Law at University of Minnesota Law School. And Alan, it's great to have you here. So let's talk about what's next. What happens now that we have this ruling?
Well, what happens now is that on the 19th, on Sunday, the ban goes into effect. What we expect is that app stores like Apple and Google will take the TikTok app off of their stores, that Oracle, TikTok's cloud service provider, will stop providing TikTok services. And TikTok itself has said that it will actually fully shut down operations in the United States, even though technically doesn't have to under the law.
Max, when it comes to the odds of enforcing, I think that's a big question right now, because that also appears to be dwindling under the President-elect Trump administration. How does that play out? What does the legality of that look like?
Well, it is within Trump's power to direct the Attorney General not to enforce the law, but the real question is whether non-enforcement is going to make a difference. The law doesn't need to be enforced for it to matter. If you're Apple or Google or Oracle, your lawyers are going to start telling you on Sunday that you're bound to this law and that if you violate it, you are potentially opening yourself up to some serious legal liability, up to $5,000 per user. And TikTok has 170 million users, so that adds up pretty quickly. So Trump can say that he's not going to enforce the law, but the real question is that going to be enough for the Apples and Oracles of the world to continue doing business with TikTok? And I have no inside information, but if I was their lawyer, I would not advise them to.
When it comes to, I guess, the likelihood of what happens, discussions, of course, of a TikTok sale going to Elon Musk, how exactly that would look for our viewers, for our community right now, wondering whether or not they're going to have access to TikTok come next week. What would you say?
All indications suggest that they will not have access to TikTok.
And when it comes to the potential, because a lot of questions are also big tech's role in this, right? When it comes to the Apple's App Store, when it comes to Google, the fines that they could face, right? If they don't enforce this measure, that's also on the table.
That's right. I think that's the main consideration. But also, it's important to point out that TikTok has said specifically that although it itself is not targeted under this law, the law is not enforced against TikTok, it will shut down all services in the United States come Sunday. And I think the reason they're doing that is to send a message and to make very clear what the impact of a TikTok ban could be, and therefore to put pressure on Congress and the Trump administration to do something.
All right, Alan, thanks so much for breaking down the legality of this. So what happens now with TikTok's 170 million U.S. users and the billions of dollars in revenue that's generated from the social platform when access to the app is interrupted? Joining us now to break it all down, we want to bring in Rohit Kulkarni. He's Roth Capital Partners Senior Research Analyst. Rohit, it's great to have you back here on Yahoo Finance. So what does this mean for the 170 million users? I was just asking the legality part of the side of the equation to a prosecutor here. Alan, what do you think the users need to be prepared for?
Hey, look, this is a very, very historic event. And no matter which way we cut it, no matter where you are on the political and other side of things, this is a significant event in the history of tech and cross-border tech as far as the US is concerned. 170 million people using the app, more than 100 million using daily. That's a lot of hours that will free up starting Monday. On average, a typical user spends more than an hour on TikTok on a daily basis. That means some of those hours will go to companies like Instagram and YouTube, perhaps Snapchat, maybe other companies like Reddit and Pinterest. And where would the money go? I think it would just follow the waterfall of the market share. We have the companies, Google and Facebook as the biggest market share companies. Most likely advertisers would probably take that money away from TikTok and go back to those two. There could be some windfall for other smaller players, but that remains to be seen. Advertisers are very nimble nowadays. The moment they see eyeballs flow over, they'll follow those eyeballs, and those eyeballs will track dollars too. So that's it's. But we need to take a step back. This is a pretty historic event in the history of global tech.
So it sounds like, is Trump ultimately going to save it in the long run?
It's hard to say. I think TikTok could be used as almost like a ping pong ball between US and China, kind of geopolitical negotiations that Trump hopes to kind of negotiate over the next weeks, months or so. But in the meanwhile, the reality is that Apple and Google will likely remove TikTok from the App Store, which means in the next month or so. Users are going to be in a limbo. Advertisers are going to be in a limbo. I don't think this immediately reverses in the foreseeable future.
Rohit, talk to me a little bit about the ripple effects across the tech sector, not only from who is positioned maybe to gain some of the users that are no longer going to be using TikTok, but also maybe does it set some sort of precedent just in terms of foreign tech companies here in the U.S., the presence that this sets, especially amongst those from China?
Absolutely. I think this puts the companies that are exporting a lot of intellectual property to China and from China on the radar. For example, companies that are in the AI race. That's something that's going to gather a lot of political targeting over the next few months, because now we have a precedent who wants to negotiate and who wants to use these chips. That's a totally coincidental pun, to be honest, to negotiate with China. So I think this sets up a negotiating tactic for many things and probably puts Trump in a very, very powerful position.
Rohit, I'm not sure if you've heard of Rednote. Of course, that has gained in popularity here this week. A lot of these TikTok users are now moving over to Rednote, saying that they're going to take their videos. There are a U.S. official coming out saying that app could actually be banned now in the U.S. Is that likely, just given the fact that obviously it would face a lot of the same concerns, at least at face value of what we know now, as to what we're talking about with TikTok?
Yeah, absolutely. It is so ironic that teenagers and young kids are moving from one Chinese app to another Chinese app with the hopes of that sticking around for the foreseeable future. I think it's just a flash in the pan, in my opinion. It's just a matter of time when such apps kind of vanish into thin air in the next few months or so. So probably it's still Instagram, YouTube, and then maybe companies like Snapchat, Reddit, and Pinterest to gain from here.
Who is the number one winner from this? When we talk about some of the apps that could benefit, Snap's name obviously mentioned a handful of times. Meta, you also have YouTube. Who, from your view, stands to benefit the most?
I think Instagram, which is Meta, is the one that has the best kind of mousetrap for both users and advertisers. Almost every advertiser on Instagram also probably spends some time on TikTok from a dollar and share of kind of mind standpoint. And here's a wild card winner, I would say. TikTok did something with social commerce which neither of the big guys, Google and Facebook, were successful at. And now Amazon is a number 3 ad company in the world. And there is nobody better than Amazon to crack that kind of puzzle of social and commerce and do the impulse buying on their platform. So there is a scenario here that the wildcard winner here is going to be Amazon through the disruptions of social commerce that with TikTok going away.
All right, Rohit, great to get your insight. Thanks so much for taking the time to join me here this morning.
Thank you.
We've got much more of your market action ahead. Stay tuned. You're watching Catalyst. Markets off to a strong finish here to end the week. It was the best week for the S&P 500 that we've seen since the election. This risk-on mentality coming back into the markets as we look ahead to President Trump's inauguration on Monday. Joining me now with some of the top trades to keep in mind what this could ultimately mean for investors moving forward. We want to bring in Max Kettner. He's HSBC's chief multi-asset strategist. And Max, I think the big question surrounding here is on volatility and what exactly investors need to know or expect here in the coming months. Is that going to die down at all?
Yeah, I think, with yields probably moving a little lower in the next couple of months, because we do think that particularly underlying inflation could actually go down a little bit in the first quarter in particular, particularly compared to where we were in the first quarter last year. That actually should be allowing for volatility to come down. Of course, we've got this policy uncertainty and all those kinds of things. But at the end of the day, what really, really matters is the earnings delivery. Can the S&P 500, can they really deliver those earnings expectations or beat them? What matters is the Fed really, just like we were fearing in the last couple of weeks, are they really going to shift away from rate cuts towards rate hikes? As long as that doesn't happen, and as long as we've got these perennially pretty low near-term earnings expectations, that low bar to beat, that continues to be a really, really good risk-on setup for markets in general.
Is the rate hike conversation dead following that CPI print?
I think it is. I think, yeah, look, there is this tendency, I think, in markets right now, and not only right now, but really the last 2 years, where in reality, inflation's always been kind of stuck. We had, we just got to download a core CPI or core PCE chart. In reality, we had an inflation shock. That inflation shock died away. We had the disinflation, and then we got stuck, right? We got stuck 3 quarters along the way. And now the market, however, is playing that as either a completely new inflation wave, right? The market is freaking out over we're on the brink of a next inflation wave higher, or just like we had during July, August, September, the market is saying inflation is completely dead. We're going to go towards 2% or even lower. And now it's growth scare. Now it's really growth that dominates the inflation concerns. And now we're pricing the Fed to actually undercut through the neutral rate. And both ends are too extreme. It's neither is inflation really going to die away very quickly. So it's not going to go anywhere near where we were in the 2010s, nor is inflation really on a massive brink on breaking out to the upside. But the market, of course, that pendulum swings from one side to the other, just like you were asking, the hawkish extreme, that pricing of rate hikes next year, that I think was a bit too much on the hawkish extreme. I'd much rather expect the next few months, particularly the first half, to go a bit more dovish again.
Max, how are you factoring in the wild card of tariffs, just in terms of what your base case is now and how you're factoring that into your models, just given the unpredictability side and nature of a second Trump presidency?
Yeah, look, we don't really factor in it that much, to be honest. I think the earnings impact from tariffs, particularly on the S&P 500, is a little exaggerated. When we look at, the foreign revenue exposure, for example, of S&P 500 companies, that, of course, is lower than, for example, in Europe. But even in the Eurozone, look, for example, at the struggling German economy, but then you look at German large caps and some of those mega caps in Germany, they've got their largest asset base actually in the US, not in Germany, not in Europe, where you might think that they're going to be hit by tariffs. So we're not really factoring it in that much. To me, really, what matters much more is what we've just heard from the IMF. That growth globally is on a better footing than we thought. Clearly better than we thought during the summer last year. What matters is the earnings delivery. What matters is, the sort of binary Fed outlook. Are we going to go from cuts to hikes, or can the cuts continue, however more gradual that they may be compared to what we were pricing during the summer, but it's still going to be cuts. That is the much more important thing. I like to compare it to 2019. Remember, in 2019, we were faced, and markets were faced with sort of perennial trade tensions as well from the first Trump administration, and still the S&P went up by more than 30%, the Nasdaq went up 40%. Why? Because the Fed was making a U-turn. The Fed in January said, oh, you know what? We've overdone this. We got to stop QT. Bank reserves are too low. We need to pump in a bit more liquidity towards the end of 2019, and we need to cut rates. And that was much more important than the ins and outs of the daily politics.
Max, I know you were looking into whether or not maybe now might be time to up the exposure to European equities and how exactly the U.S. equities compare and stack up versus European equities. Where do you stand on that strategy?
Yeah, I don't think it's an either or between Europe and the US. I don't think it's okay, let's get out of the US and go back into Europe, or a sharp overweight US over Europe. I think it's actually there's a case to be made for buying both at the moment, because particularly what should be working going forward in the first half of this year within Eurozone equities in particular are those export-sensitive companies, are those export-sensitive equity markets like German large caps, like the DAX, that is deriving a lot of its revenue from foreign sources, where the lower euro, the weaker euro, clearly should start to help Eurozone earnings, and particularly sort of those mega cap earnings in Germany, for example, but also overall in Europe. Clearly, when we look at companies that derive most of their revenue from foreign sources or from the US in particular, that weaker euro compared to the dollar really should start to matter and should be underpinning a bit of earning strength in the Eurozone.
All right, Max, great stuff. Thanks so much. Let's get to some of the trenders in today's market. I'm joined at the desk by our very own Josh Schaefer. You can scan the QR code below to track the best and the worst performing stocks here of the session. There we have it here. All right, let's talk more broadly speaking and take a macro view. The S&P right now, as we look ahead to President Trump's inauguration on Monday. When you take a look at the S&P 500, historically, the index tending potentially to rally in the 3 months following a presidential inauguration. This is according to data coming out from Jefferies. So if this trend plays out, would it be a relief here for investors who saw that the post-election rally stall out at the end of 2025, end of 2024, the start of 2025? I guess how much should we really be buying into this theory? Historically speaking, it's obviously always hard to predict the future, but I guess maybe we should be a little comforted.
Well, past performance is no indication of future results, right? Should we start with that? Should we start with this time might be different? But I guess I will lay out the case, Shauna, for why this time could be a little bit different, right? So we have a story that's going up over the next couple of days explaining how a president has never really entered a stock market like this one, right? So yes, we have a new president come in every 4 years, but take a look at the equity market right now. You have 40% of stocks, or basically 10 stocks in the S&P 500, right? About 40% of the index is just the top 10 stocks in the market. Mm-hmm. Valuations are at about levels that we saw in 2021 and not seen other than that, than the dot-com bubble, right? We're in a Fed period right now where we're wondering, is the cutting cycle over? Could they potentially hike at some point this year? You were just speaking with the strategists who argued that conversation's largely over, but that conversation could come back, right? There's just a lot of things happening right now that don't necessarily have to do with the incoming president, Donald Trump, and don't necessarily have to do with his policies either. Then when you add that in, there's a lot going on there, but I do think you can take the Jefferies note and also spin it positively and think about what Bank of America's Michael Hartnett said today about Trump potentially just being supportive of the stock market, right? And those takes still exist, right? Deregulation is good for financials. Trump's America First policies could be good for small caps. We saw those rallies play out in the month after the election. They dissipated, so now maybe they actually have a little bit of room to run. I think there's a part of this. We had the post-election rally. We came back a little bit. Well, at least Trump isn't entering the stock market at its peak like it felt like he was going 3 weeks ago, right? Some of these trades, financials, small caps, even the S&P 500, are not back at the levels they were peak post-election. So there is a little bit more optimism that is perhaps not fully priced in at that level.
I guess also the question is how much maybe does the strategy really need to change, just given the fact that we could see an increase in volatility because of the fact that we could see more of a whipsaw nature. Maybe it's not the best way to describe it, but back and forth, flip-flopping here, coming out from the administration, and maybe how much of that is going to be preemptively already priced into the markets just in terms of trying to get ahead of the news rather than reacting to it.
Yeah, it's a question of what feels least priced in right now, right? And I think what strategists would tell you is probably least priced in would be perhaps the U.S. economy underperforming, right? If some of these policies turn out to actually hurt economic growth. Right now, the market is sort of positioned for a U.S. exceptionalism sort of trade, probably a strong dollar, probably rates continue to remain relatively high. If those things start to reverse pretty aggressively, I think that would sort of shift the narrative here. So it's really about what has the market already started to anticipate with Trump. So if the dollar keeps chugging a little bit higher, that's not necessarily shocking at this point, right? That's been the trade. Mm-hmm. It's if that doesn't happen, what does that actually mean for the market? And that, I think, would cause even more volatility, and we'll start to maybe get some of those answers in the next couple weeks, months. I think that's the looming question, right? Is how long does it actually take for some of these policies? Specifically, I'm thinking tariffs. Everyone wants to talk about it right now. It's the big talking point on earnings calls. It was the big talking point in the Fed beige book. People are really waiting to hear what happens there. How long does it actually take to get answers? Because I agree, it's going to be jittery until we do.
Yeah, exactly. We heard a little bit from Bessent yesterday, and he kind of tamped down some of those wild expectations when it comes to tariff, maybe pointing more towards the fact that it could be more of a negotiating tactic. But time will tell. All right, Josh, thanks. Well, the Biden administration confirming funding for clean energy projects just days before Trump takes office. The Department of Energy announcing financing for Rivian to construct a plant in Georgia, as well as a loan for Plug Power. Our very own Praz Subramanian joining us now with those details. The Biden administration, once again, trying everything it can here for renewable, for clean energy here ahead of the transition.
Right, trying to get ahead of that transition there. You know, this is money that's already been it's approved for dispersal. Rivian and Plug Power did what they needed to do to get these funds actually fully committed, and now they're being dispersed. And look, this for Rivian in particular, this is their future, right? They need this money, $6 billion, to make that Georgia factory. This plus their deal with Volkswagen kind of gives them the runway they need to be a successful EV startup, right? And to continue with their newer models. A lot of this funding actually is going to places like Georgia, right? We mentioned these are red states that may not want to lose these projects. It's a little bit complicated as to what they can do, whether they can actually stop it. I think Ramaswamy of Doge and Musk have talked about potentially looking into these deals, but calling them last-minute funding. But it's probably going to be difficult to stop the funding after now they've been approved. So we'll see what happens. But pulling funding might not be so popular either. So we'll see. As you say, time will tell.
Time will tell. All right, well, let's talk a little bit about tariffs and the impact that could have on the auto sector. That's one of the overhangs here, more broadly speaking, with the industry. You and I both had the chance to speak with Tom Donnelly. He's Mazda's North America president and CEO earlier this week about the impact on tariffs, what it would ultimately mean for his business. Let's take a listen to what he had to say.
What's clear is no business in any industry can absorb the magnitude of what's being talked about here. These are decisions that take, have a months to potentially year time frame in terms of the adjustments you make.
Surprised that's how Mazda is thinking about it. I guess, how big of a challenge do you see it being for the industry?
I was surprised when he said no industry could absorb the magnitude of that. That was kind of surprising to me. I know the auto industry is scrambling to figure out what they can do. With Mazda in particular, they assembled in Japan, their home market, but also in the US and Mexico. So they're trying to shuffle their production. Other companies are doing the same thing, but that takes time and it costs money, and you got to set up expensive supply chains. So this is happening already within auto industry in flux, right? We have a good year for the industry last year, but you have high pricing, you have high finance costs, you have some companies having bloated inventory. So they're struggling to kind of sell vehicles. You have the threat of tariffs. And then we haven't even talked about the EV tax credit going away. A lot of companies invested billions into that, and that might make it harder to sell that product. So this is where the auto industry finds itself. But with Trump, again, I got to say one last thing. He's unpredictable by nature. He might say, you know what, let's keep the tax credits, lower the tariffs, or reverse, do high tariffs, and get rid of the tax credit. So it's hard to say what's going to happen, but the auto industry is definitely in a tough spot right now.
Yeah, certainly. And I was speaking to Tom Narayan over at RBC a couple of times here over the last several months, and he was just talking about how unpredictable Trump is, how that makes it so tough for automakers in general to do business because of that planning aspect that you were just talking about. Obviously, it takes time to adjust to these potential tariffs. All right, Pras, thanks so much. Well, coming up, we will continue the conversation surrounding tariffs and other proposed Trump policies on the economy, what it ultimately means for economic growth. That's coming up next on Catalysts.
From Wall Street to Main Street, America is gearing up for Donald Trump's second term as president. And President-elect Trump is promising big changes. Investors have questions, and Yahoo Finance is bringing you the answers. Will Trump's second term as president bring another year of strong gains for the market? What does the future hold for cryptocurrencies? And which companies are most exposed to those proposed tariffs? Tune in for conversations with experts, analysts, and former administration members, starting on day one.
President-elect Donald Trump officially retaking the White House on Monday. Trump is expected to sign several executive orders on day one that could impact the economy and the markets. Our next guest is here with three key policies for investors to watch under the incoming Trump administration: tariffs, corporate tax changes, and also immigration. Joining me now, I want to bring in Jeffrey Roche. He's a chief economist at LPL Financial. Jeffrey, it's great to speak with you here this morning. So let's start with your number one thing, and that was tariffs. We just heard from Trump's pick for Treasury Secretary Scott Bessent yesterday. He had this to say about the approach that he sees the Trump administration taking with tariffs. Let's take a listen.
The American people should think about tariffs in three ways under the Trump administration. One will be for remedying unfair trade practices. Two, maybe for a more generalized tariff as a revenue raiser. A third use of tariffs, as you said, as a skilled negotiator.
So, Jeffrey, I think the big question here this morning as we look ahead to the next 4 years is the economic impact, right, that tariffs could potentially have here, not only the U.S. economy, but the global economy. How are you evaluating that?
Yeah, well, first off, thanks for having me again. Good to join you this morning. Just a reminder for the listeners, we're not walking into a dark room and not knowing exactly, how tariffs do impact an economy. We do have a Trump 1.0 case study. And I think it's really important to look at the numbers. You look at a chart of CPI and PPI, which is producer price index, and you realize, in 2017, 2018, 2019, businesses didn't fully pass along costs. And that was during a time when China was growing amazingly stronger than the U.S. Tables have turned, actually, in 2025. So I think that scenario is very helpful. I don't have a very negative view as we go into the Trump 2.0 because we have that case study with us to study how things happened with that.
And then, of course, the other big factor is tax cuts, right? And just in terms of to what degree that is going to facilitate or offset the debates out there, just ultimately some of the pricing going forward here for the U.S. Scott had this to say when he was asked just about the plans for the extension of the 2017 tax cuts and the importance of tax cuts for the U.S. economy.
This is the single most important economic issue of the day. This is pass-fail. That if we do not fix these tax cuts, if we do not renew and extend, then we will be facing an economic calamity.
Jeffrey, would love to get just first your thoughts on the fact that he described it as the most significant economic question here of today.
Well, that might be a little bit hyperbole, but I do think it's extremely important. You can't ignore deficits. You got to pay for those tax cuts somehow. And you got to address the massive income inequalities really ever since the pandemic. Certain parts of the economy have done quite well. And others not quite so much. So taxes, just to zone in on that topic, because I do think it's one of my top three in addition to tariffs. The second is that tax rate. I do know that when you look at, for example, the NFIB surveys, we had a really fantastic rebound in businesses reporting plans to expand. And I think that's partially due to the fact that the Trump administration does plan to lower corporate tax rates. I think that is incredibly pro-business. And we do know from previous cycles, pro-business policies seem to be the best variable to play with when you do think about the challenging deficits right now.
Jeffrey, to wrap this up, the number three most important thing is immigration. And of course, Trump has promised to start mass deportations. What's the economic fallout there?
Well, it's not going to be felt evenly across the economy. Clearly, the construction sector, leisure and hospitality sector, those areas are going to be hurt with perhaps a little tighter immigration policy. But I do think it's fascinating. You know, we do get some really great data from the Bureau of Labor Statistics on foreign-born workers. Now, granted, that includes those here legally, but it does include immigrants and some illegals. And when you look at the foreign-born participation rates and employment to population ratios, we don't have those rates as high as they were back pre-pandemic. So it's actually likely that tighter immigration policies would actually nudge domestic-born workers to re-enter the labor force, and that certainly would be a good thing for Americans.
So you don't see a crackdown of that at all risking slowing economic growth?
I think there might be a temporary slowdown, kind of like what we've been working through the last couple of years. You know, no broad recession, but we had these pockets of recession, housing, for example. I think with a hit to immigration, you might have a slowdown in some sectors, like I mentioned, leisure, hospitality, but it's not going to hit all sectors the same way. And again, I think it might be a net positive for getting Americans back to work and back into the labor force.
All right, Jeffrey Roche, thanks so much.
Thank you.
Well, tariffs are expected to be an issue for retailers this year. Our very own Brooke DePalma got the chance to speak with a number of industry leaders at the ICR conference. You were also at NRF. Before that, a very, very busy week. But Brooke, the big question is, what are you hearing from industry leaders just about how worried they are about tariffs?
Yeah, you would think that this would be a huge conversation at both National Retail Federation Conference and the ICR Conference in Orlando, Florida, but it really was just lingering in the background. Many retailers taking this wait-and-see approach as they don't really know exactly what could happen this time around, and many think that it'll be used as a negotiating tactic. But one expert telling me that retailers have this concept of a playbook plus. Essentially, this time they think they're in a better position because they transition more products out of China, but many, including Joe Feldman here, saying that it's going to be an impact and that eventually, if this does take effect, then prices could increase for the consumer in the next 3 to 6 months. But of course, companies are looking to mitigate this risk. They're looking to reallocate production should these tariffs go into effect, and also work with their manufacturers to potentially swallow some of those costs as well.
Brooke, when it comes to who stands to be impacted the most from these tariffs, what can you tell us there?
Yeah, discounts retailers as well as footwear retailers, they're going to be impacted the most right here. So think of these top two. You think of Five Below and Dollar Tree. Roughly 40% of their products sold are direct imports. Now for Five Below specifically, a majority of that 40% does come in fact from China. Of course, many experts saying that China could be the first one that goes into effect. But if you take a look at both Five Below and Dollar Tree stock over the past year, this has been weighing on top of investors' mind. Both of those stocks down roughly 50% in the last year. And if you take a look at footwear retailers, feeling a similar nervousness because of the fact that 99% of shoes are imported into the U.S. from countries like China, Vietnam, and Indonesia. The U.S. brings in about 2.5 billion shoes per year. And the footwear industry already pays about $4 billion a year in tariffs. And so they could feel this directly. Now, I did speak to On Holding. They are a footwear company that is based in Switzerland. They import a majority of their products from Vietnam and Indonesia. So should tariffs go into effect on China, they won't be impacted as much, but they'll certainly feel that impact if it is overall international imports.
What about the larger players? When you take a look at Walmart, when you take a look at Target, is this a big headwind for them?
Yeah, well, anything that Walmart tends to do, other retailers do follow. And so while it's not a big headwind, we know that Walmart manufactures, grows, assembles, produces about 2/3 of their goods here in the U.S. But that means that they still are exposed to about 1/3 of their products sold from an international standpoint. And we did speak with Doug McMillon, CEO of Walmart, earlier this year, and he said that we're positioned to manage it, but I worry about customers experiencing higher prices. We're going to do everything we can to try to keep them low. And on the flip side, another big box retailer that we'll certainly be watching in all this is Target. Target, from what I'm hearing from sources, is that they import about half of their goods sold from an international, their international imports make about half their goods sold. Of course, Target sells a lot less food. They're more known for their discretionary discretionary merchandise, which typically comes from international imports. One expert telling me that they have a lot of leverage here. They're certainly going to work with vendors and mitigate some of those price increases, but definitely one to watch. 1/3 of Walmart's goods directly imported, about half of Target. So really be watching these big box retailers to see exactly what they do. I'm sure other retailers will be keeping a close eye as well.
Great for investors to keep in mind. All right, Brooke, thanks so much. Well, coming up, Trump reportedly planning to take action on cryptocurrency as soon as he takes office. What it could mean for the industry, that's coming up next on Catalysts. Bitcoin back above $100,000 as the markets price in a crypto-friendly environment under the incoming Trump administration. Now, this coming as Trump reportedly plans to sign an executive order making crypto a national priority that could come on his first day in office. Joining me now, I want to bring in Kavita Gupta, Delta Blockchain Fund founder and general partner. Kavita, it's great to have you. So when we talk about Trump making crypto a national priority, I'm curious, how are you and those within the industry thinking about that? What does that mean?
It feels, first of all, there is a big feeling of thank God we are no more in gray area. We are not talking to crypto people, especially like us, people like us who have been in the space since 2013, not like, oh, you may be shady. So it feels like now every institution, every government, every country's president is talking about it, which is absolutely great. But at the same time, the question is, it's a great headline, never thought of it, but how are we really going to do it? And what are we going to do with the volatility when the markets are actually going to be down, taking the whole US Treasury valuations down? But I really believe in the whole crypto administration, and I am very excited to see how is that going to change the world.
What action do you think is necessary or needs to happen, not obviously on day one, but to be at the top of that priority list and happen within the first few months of the Trump administration?
Shauna, very simple. Have clarity, like what is right and what is wrong. We do want retail customers to be protected. Nobody in the crypto industry, any legit player has ever said, hey, this thing all is a FUD, right? We do want to protect retail customers. We want to work very within the government bounds. So just have the clarity which SEC in last 7-8 years have failed to provide, that this is your Bible, work around this, and then you are a part of similar institutions like BlackRock's of the world, Goldman Sachs of the world. And that's it. The clarity on the regulations is and should be the first priority.
What do you think this is going to do? Just we obviously don't know what is going to be put in place, but from the priorities and some of the rhetoric coming out from the incoming Trump administration, how does that position the U.S.'s global standing within the crypto industry?
US, everybody around the world has always looked at US, right, on most of the regulations, especially technology regulations. And US was lagging only in the crypto regulation. We had Dubai, Middle East much ahead of it. We had Singapore, a lot of Asian countries ahead of it. Europe at some point, especially Portugal, France were ahead of it. And I feel like now US will take its right position as the head. Also, we were losing a lot of talent from US, a lot of amazing engineers, builders, developers, entrepreneurs in the blockchain industry were leaving. And I was seeing the same fear with the AI industry of leaving and going around the world to build the project, because you don't know whether you are in for tax liabilities, which you never knew you were supposed to pay, whether you are in for some new rules on regulation on decentralized finance, you didn't know it existed. So I feel like not only US is going to be back as the visionary in how the blockchain should be done and crypto should be done, but also a lot of talent is going to be back in the country.
Good. What about when it comes to crypto IPOs and unlocking some of that value there? What do you think that activity is going to look like?
Oh, it's going to be great. I feel like next 2 to 3 years, these going to be years for a lot of IPOs and M&A in the blockchain industry. People have only known blockchain so far for the cryptos and tokens, but I feel like that's going to change. I'm waiting. I think Circle is going to be a big one. I feel like Kraken is going to be another big one. Falcon X is getting prepared. Anchorage, which I'm very excited about. I feel like there are going to be some of the biggest IPOs are ready to happen in the blockchain world.
Is there any risk associated just in terms of too much excitement maybe already being priced in when you take a look at Bitcoin this morning trading right around 103,000? Is there a downside risk here?
There's always going to be a downside risk, like any other liquid market, right? There's going to be ups and there's going to be down. Within an year from today's time frame, Bitcoin was also sitting at 60K, right? And then if you take the 2-year time period, we are talking about 30K price point. So volatility is going to stay. I think it is now when we look at the crypto, Bitcoin, ETH, Solana, like just the crypto token perspective, we're going to have a lot of institutional ETFs. And yes, this is also going to be next 2-3 years for ETF from Solana, XLR. And I feel like prices are going to be volatile for sure. But what is over time, this is the right pathway like gold or any commodity for these prices to find some sort of a base and less volatility. And that only comes when you have more clean regulations around it. The other thing is I feel like the technology is for the first time will have the space to surpass just the fancy, sexy headlines of crypto prices going from 30K to 100K.
All right, Kavita, we have to leave it there. Thanks so much for giving us some of your time. Really appreciate your insight.
Thank you.
Coming up, some of tech's biggest names are heading to Washington next week for President-elect Trump's inauguration. We've got that and more for you on tech cozying up to Trump. That's coming up next. Big tech is cozying up to President-elect Trump, with many top tech executives set to attend his inauguration on Monday. Among those business leaders is Tesla CEO Elon Musk, Meta CEO Mark Zuckerberg, and Amazon Executive Chair Jeff Bezos. You also have Apple CEO Tim Cook, Alphabet CEO Sundar Pichai, and TikTok CEO as well. One top executive who won't be in attendance, though, is Nvidia CEO Jensen Huang. Now, Huang already had travel plans. He will be traveling to China and Taiwan. While Huang will not attend the inauguration, has yet to visit President-elect Trump at Mar-a-Lago, he did tell reporters Friday that, quote, "I'll look forward to congratulating the Trump administration when he takes office." Tech CEOs won't just be sitting behind Trump as he's sworn into office. Many have contributed to his inaugural fund. First, when you take a look at some of those campaign donations, according to the Federal Election Commission, Elon Musk contributing at least $260 million to Trump's campaign. That was through his America PAC and also other smaller funds. Now, when it comes to the inauguration, Meta donating $1 million to Trump's inauguration fund. Meta now did not donate to either Biden's 2020 or Trump's 2017 fund. Meta CEO Mark Zuckerberg also met with Trump and Musk at Mar-a-Lago. And Meta also announcing the end of its content moderation program, a move very much seen as cozying up to President-elect Trump. Now, Amazon also donated $1 million to Trump's inaugural fund and $1 million in-kind donation by streaming the event on Prime Video. That tops his $58,000 donation to Trump's 2017 inauguration. Amazon streaming service will also release a documentary about First Lady Melania Trump later this year. Other tech companies that contributed at least $1 million to Trump's inaugural fund includes Google, Microsoft, Uber, and Coinbase. CEOs that have contributed $1 million to the fund include Apple's Tim Cook and OpenAI CEO Sam Altman. Well, coming up, Wealth is dedicated to all of your personal finance needs. Brad has you next.
It's time for Yahoo Finance's Market Minute. Stocks are higher on track for a big weekly win. In our top stories, the Supreme Court ruled against TikTok, upholding the ban set for January 19th unless it's sold to an owner not controlled by a foreign adversary. The government argued that TikTok's parent company, Chinese-owned ByteDance, presented a national security threat. Meta and YouTube are expected to be some of the biggest beneficiaries of the 170 million Americans TikTok users looking for alternatives. And Apple temporarily pausing its Apple Intelligence-enabled news notification summaries. That's after complaints it repeatedly made factual errors. Now, this affects iPhones, Macs, and iPads with its latest beta software update. And Intel shares rising on speculation it's an acquisition target following a report from tech site Semi-Accurate claiming to have read an email about a company trying to acquire Intel whole. Yahoo Finance has reached out for comment. Intel has struggled over the past year to keep up with chip rivals, the stock down more than 50% over the past year. And that is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the stocks of the day. Wealth starts now.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, evaluating your portfolio. We'll talk to one portfolio manager who says investors should be cautious in the near term, but optimistic for the year. And the surprising reason why Gen Z is allocating more funds to cash and bonds than any other generation. We dig into the results of a new eToro survey. Plus, budgeting hacks. We discuss how you can start living more frugally to make your money stretch without giving up the things that you enjoy in life. We've got all that and much, much more coming up during today's hour. But first, we take a look at some of the market action. 90 minutes into today's trading session, stocks climbing today. The S&P 500 on track for its best week since the election. Joining me now, we've got Robert Pavlik, who is the Dakota Wealth Management Senior Portfolio Manager. Good to have you here on the show with us. Robert, you say that you are more cautious in the near term, but cautiously optimistic for the year. Why is that?
Well, I think that, the market had a bit of a check back. We got down about 5%. And I think there was a little bit of realization after the election that, first of all, things were going to go great. Trump was going to have these deregulations. He's going to sort of cut taxes. Business would do very well. And I think that there was a little bit of a realization that, interest rates were on the rise. It was because maybe Trump was going to cut taxes. It was going to increase the deficit. Trump is talking about tariffs. He's talking about deportations. And I think all together gave the market a bit of a sort of a realization that maybe, things may not go as smooth. Also, inflation continues to be a bit of a concern. Bond yields at 460, on a 10-year is still a bit elevated. Valuations are a bit high, about 22 times, about 10% higher than the 5-year average. There's questions about earnings growth. But I think as we go through the year, things start to look a little bit more optimistic. I think earnings, the market's going to realize earnings are going to grow probably about high single digits, about 9%. The economy will continue to grow, maybe about 2.5%. It's not a recession by any means. Valuations will ease. I think tariffs are really just a bargaining chip. Mass deportations are not going to happen. Trump's energy policies are going to probably help lower the price of oil and gasoline, and that should help inflation ease. And I think as we get to sort of the middle of the year, there's going to be more and more talk about the Fed returning back to the market, maybe a couple of interest rate cuts. And I think we actually end up having a pretty good year. I have a target of 6750 on the S&P 500. So I think, something like 13-14% from here is actually a pretty good year.
It's really interesting, especially considering the cautious optimism that you were discussing versus something like what Jamie Dimon was talking about in a CBS interview earlier this week, which was cautious pessimism. So, and I should say that his was more focused on the economy. So how do you see and pair kind of the cautious pessimism from the chairman and CEO of the largest bank in the U.S. versus what the markets might maintain as cautious optimism?
With all due respect to Jamie Dimon, he's actually been wrong several times. I think that there is a reason to be cautious near term. I think the first 100 days of the new administration's policies and what they bring to the table is going to create a little bit more nervousness in the market. But I think that all sort of plays out as we go forward. And again, I think the optimism that the Federal Reserve returns back to the market with interest rate cuts because they don't want the economy slowing into next year actually helps lift the overall market. Once we get to a more rational point of valuations, that helps lift the overall market later on. People start to feel a little bit better about returning to stock purchases. Now, again, this seems a little bit ridiculous when the market's up almost 400 points today. But again, I think there's some nervousness heading into first quarter earnings season, what the first 100 days looks like. Inflation's still remaining a bit high. But I think that all sort of works out as we go forward. I think the key to some of the inflation numbers is, again, Trump's policy towards energy. He's going to pressure the oil companies to continue to pump out more oil, and that helps reduce the price at the pump, which also helps reduce the cost of groceries at the grocery store, and people start to feel a little bit better.
All right. We won't debate Jamie Dimon, but you say he's wrong, and J.P. Morgan says he's worth $36 million last year.
Yeah,
we'll continue to discuss that at a future date. We want to get to some of your stock picks for us. What are you watching right now?
So one of the stocks that I like is Lululemon. The stock has a great looking chart. It looks like it's a big cup and handle. They reported a good earnings back in December. They reported just an increase in estimates for the fourth quarter. The holiday season had good earnings, good sales. They have a good membership program. There's a real dedicated customer base. I think you're probably looking at about 450 on that stock. That's about 16% upside. The next name is coming, CMI. And again, I think the key to this is power generation. So there's demand at the data center and power generation. Earnings are expected to grow about 10%, a price target of $400. That's about 10% upside, trades at 1.9 PEG, which is about 9% below the 5-year average. And the last name is Quanta Services. And Quanta Services has a record-breaking backlog, strong demand for future products. Data centers, aging power grid are the reason why this company's moving forward. And actually, I hate to say this, but it's true. They have operations in LA. They have a subsidiary about 40 miles outside of LA. Earnings are projected to grow 18%. I have a price target of $370. That's about 16% upside on that stock.
Interesting. Robert, we're going to continue to track all these picks. We got to check back in with you later on this year to see what's holding true. Appreciate it.
It's great to see you.
Good to see you too. The Supreme Court unanimously upholding TikTok's divest or ban law, meaning that unless the app's Chinese parent company ByteDance sells its U.S. assets, TikTok will be banned starting Sunday. Joining us now with the details, we've got senior legal reporter Alexis Keenan. Alexis, what do we know from this SCOTUS filing here?
So yes, unanimous as to the decision to uphold this law, saying it is constitutional. As for TikTok and as applied to TikTok's users, right? So the whole basket, the Supreme Court deciding here that the law will be in accordance with the Constitution. Now, I want to read some of the decision for you. This is the way that the court is working through the reasoning here. They say that no doubt for 170 million Americans that use this platform, that it's distinctive and that it offers this expansive outlet for expression, engagement, community. But they say Congress has determined that divestiture of the app is necessary to address its well-supported, they say, national security concerns regarding TikTok's data collection practices and its relationship with a foreign adversary, there being the Chinese government. They say we conclude that the provisions, meaning the law, does not violate the petitioner's First Amendment rights. Now, if you remember, this case was all about whether or not TikTok had a constitutional right to be protected, to speak as it sees fit in this country and not have the government decide whether it can or cannot speak. Same for the users. So it's that limited issue here that the court is saying, nope, in this case, national security concerns, those trump the ability of a foreign adversary to speak. This is a historical decision, really making a precedent for how a technology company that is not owned by a U.S. firm or a country or under the control of a country that is an ally or a friend to the U.S., really making a distinction here that this is going to be able to be done in order to curb a foreign country from having some level of control over a technology company and the speech of it and its users.
Two other thoughts come up immediately when we're talking about this, and you can respond to either one of these, but one of them, of course, the reaction that we're seeing in other social media stocks here today on the back of this, but then the other is this ban is going to go into effect the day before the inauguration as well. And you have President Trump saying that he's had successful calls with Chinese chairman and President Xi Jinping.
Right.
And so,
just tweeting about that
exactly,
just now, saying
just
that
posting.
he's what he actually said is that they discussed trade, fentanyl, and TikTok. There's a whole basket of things. We know that President-elect Trump has also reportedly floated the idea of passing an executive order, issuing it, but legally speaking, that's going to be an uphill battle for him. It's difficult to issue an executive order that directly contravenes a federal law. So that would take a lot of convincing, and that would be a whole nother bucket of challenges. Doesn't mean he can't try, doesn't mean there might not be an avenue there. But certainly we would expect, at least in the short term here, that companies Meta with its Instagram, maybe even YouTube, Snapchat, would be seeing a bump here. I think that's kind of what we're seeing in these early kind of minutes after the judgment has come out here.
Which is actually a flip-flop from when Trump tried to get TikTok out of the U.S. during Trump 1.0.
180.
Exactly. Alexis, thanks so much for taking the time. Appreciate it. Now time for some of today's trending tickers that we're tracking here today. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Yahoo Finance senior reporter Alexandra Canal. Ali, first up, we got to talk, not a ticker, but it does have a page of its own on Yahoo Finance. Yes. BTC USD, Bitcoin gaining, pushing up above 100,000. And then we also know it's hit its highest level so far this year on optimism around President-elect Trump. Trump reportedly plans to designate crypto a national priority. What does it seem that would mean that would take on here with that designation?
Well, the Post is saying that Trump plans to sign executive orders covering crypto debanking and accounting policies. Reuters reporting at least one crypto executive order is expected to be placed on day one. We know Gary Gensler is stepping down. Trump has nominated crypto-friendly lawyer Paul Atkins in his place. So it seems like the momentum is there. We're above $104,000 a coin, trading at some records here. It's just days before the inauguration. It has been a pretty wobbly ride, I'd say, for crypto since the election. We saw the crypto trading below $100,000 in earlier this year. We've seen some back and forth softness when it comes to that risk on versus risk off trade. But Bitcoin started to make some gains after that core CPI print came in softer than expected. And then today, as we near closer and closer to the election, we're just seeing a boon in this cryptocurrency. And that's lifting other types of cryptos, other types of crypto-related stocks like Coinbase, for example. So it's a rally that I don't think is quite done yet. I think there's more room to run here.
Yeah, the high end of that 52-week range, and our viewers can see this data on Yahoo Finance as well, 108,000. We'll see if we get back to that level and break through it as well. Next up, we got to talk about Intel. INTC is the ticker symbol, and that's the #1 trending ticker on our website. Ali, it is rising on a report from the tech-focused semi-accurate newsletter. That's what they call themselves. The founder of the newsletter says he read an email about a company trying to acquire Intel whole, and that this mystery company has the resources to pull it off. Yahoo Finance has reached out for comment. We should note as well here.
Yeah, I mean, look, Intel has had this crazy rise. At one point, it was the dominant chip maker. Obviously, the competitive environment has changed incredibly since then with Nvidia, AMD, and we've seen Intel really struggle. We have Pat Gelsinger, longtime Intel CEO. He resigned in December. We saw a lot of upheaval at the board level, and that's all been reflected in the stock price. I mean, you can see it on your screen. Shares are down 55% compared to 1 year ago. You compare that to Nvidia, well, that's up over 140%. So you see quite a big difference there. There were previous rumors that maybe Broadcom, maybe Qualcomm could potentially go out and buy Intel, but no matter who the buyer is, I think it's going to be a difficult journey to get there. There's antitrust concerns. You have Intel that has $50 billion in debt. It's a difficult transaction no matter how you really slice it. The valuation is currently at about $90 billion. So we're seeing this pop today. I don't know what that means for the future and who the potential buyer could be.
And for all of the talk around deregulation and potential M&A that we could see come forward under the incoming administration, would there be more probability, higher probability or likelihood that this would go through under a new regime?
Right, maybe now is the time.
Exactly.
Yeah.
Well, we'll see. Ali, thanks so much for joining us, breaking down some of these stock stories here for us. Retail investors are looking to adjust their portfolios as rates come down, with 76% planning to increase or maintain their investment portfolio contributions. That's according to data from investing platform eToro. For more on this, I'm joined by Brett Kenwell, who is the eToro investment analyst. Great to have you here on set with us.
Thanks for having me.
Absolutely. Let's talk about this a little bit more here. What are retail investors prioritizing from what you can see as they adjust their portfolios?
Yeah, so we really started to see this change actually come after the election, and retail investors are starting to prioritize. They want to kind of calculate their portfolios and increase their allocations into crypto and into equities are two big risk-on areas they're focused on. But cash was sort of the other focus, which was sort of interesting. It clashes with the first two options. And when we kind of dig through the data, we think it's more of an opportunistic move to cash, with investors looking to redeploy that later in the year. on some sort of pullbacks in the market and in crypto.
According to the survey, there's so much of this Gen Z allocation that's focused on cash, more than any other generation. Why do you think that is?
Yeah, that one was really interesting. I think that one kind of threw us for a curveball a bit because, our younger investors tend to be more risk on. They tend to embrace that risk. They want to see the big gains, and they're willing to sit through the volatility to get there. So to see this move to bonds and to see this move to cash really kind of struck us as an interesting move. But when you kind of consider who a Gen Z investor is, or the top age of that generation is about 27. So they have a lot of large life purchases, kind of coming up, whether it's buying a house or starting a family, getting married. So it really depends on who that investor is and if that decision makes sense for them. Otherwise, we kind of lump that in as maybe, again, taking advantage of some of the strong gains we've seen in stocks and crypto over the last 2 years.
Yeah, average first-time home buyer right now, 38 years old. So I wish Gen Z well in that effort to get that house a decade prior to that. But all things aside here, and me wishing them well, Gen Z also allocating more to high-yield bonds than other generations, as you were mentioning. Do you think this is a smart move?
Yeah, the move into high-yield bonds, particularly for Gen Z, is quite interesting. Again, it could be a number of factors. They're not as experienced as a millennial or a Gen X or, of course, a baby boomer investor. And so perhaps that's them dipping their toe into the water a bit, into the bond pond, see if they can take advantage of some of those yields. Because even though the Fed has been cutting rates, we've seen Treasury yields moving higher. We've seen some of those returns kind of coming back, even though the asset has performed pretty poorly over the last couple months. So it could be them moving into bonds to try to take advantage of that pullback.
And so, according to the survey, 59% of retail investors, they expect AI stocks to rise. Only 22% actually hold AI-related names, though. Why is that the reason, perhaps, for the range in between?
Yeah, again, when you dig through all the numbers from the survey, it kind of feels like an opportunistic move from retail investors as a whole. Mm-hmm. So like you mentioned, about 60% of respondents said that they believe AI stocks will continue higher in 2025, yet less than a quarter of respondents actually own AI stocks, which was down pretty notably from Q3, where 35% said that they had allocation to AI. So again, this feels like a moment where, because when we did this survey, it was late November and early December. That's when you had your Nvidias and your Palantirs hitting record highs. Stocks were doing pretty well. An opportunistic move into cash, taking some profits off the table. My interpretation is likely looking to buy the dip in 2025.
Okay, and so the dip in AI, are there any other dips that you think that, and see in this data, especially as consumers, according to the U.S. Consumer Confidence print from the Conference Board, the most recent one said consumers became a little bit less bullish about the stock market in this most recent reading here. It seems like there is that dip buying mentality. They're just waiting for certain pockets of those dips.
Sure, and I think for a lot of investors, they're keeping in mind what happened a couple years ago, where we had this very strong, finish to the year, finish to 2021, and then a very difficult 2022. So maybe investors trying to get ahead of that a little bit, taking profits when they can versus selling when they have to. But when we zoomed in on AI, they were bullish, but when we zoomed out, they were bullish too. That applies to the Magnificent Seven and mega cap tech. It also applies to stocks as a whole. We asked point blank to retail investors, do you expect the bull market to continue in 2025? And a majority, I believe it was about 61%, said yes, they do. So they remain optimistic for the coming year.
Really fascinating insights. Brett, thanks so much for taking the time here with us today.
Yeah, thanks for having me.
Appreciate it. Coming up, everyone, an update on the California wildfires. We'll be joined by someone who lost her home and one of her businesses in the Palisades fire. We'll discuss the process of rebuilding. Stay tuned. Firefighters in California are pushing to contain blazes across the Los Angeles area. A break in high winds has aided efforts in bringing the ongoing fires under control. As the fight against the flames continues, many turn their focus to rebuilding. Jordan Catapano, who lost her house and one of her businesses in the Palisades fire, joins us now. And Jordan, we are so sorry for all that you've lost, and we know that there's a major rebuilding effort that comes after this, but what have the past few days been like for you and your family and your employees?
Thank you so much, Brad, for having me. It's been a whirlwind. It's hard to believe that we're now a week away from that catastrophic fire. And, it's all really happening at once. I'm thrilled to say that happy to say that my family is safe and sound, and most of our friends and neighbors are all safe as well. It was very devastating to have to close our bartending business, which we really did the same day that my home burned, because that is where my home office was, as well as all of our supplies, our bartending equipment, bartending tools, uniforms, all of that. And at the same time, we've turned our focus to our other business, which is a mixer line. So it's been a juggling act for sure to file, insurance claims for our home and then also the business, and then instantly have to pivot to another business so that we can keep going.
As you were mentioning your home, and I want to come back to your business in a moment here, what has your and your friends' experience been in finding housing in this period?
I will say that it has been quite varied. My husband and I made an immediate decision to get into a hotel where we can stay long term for the time being. Of course, that seems to change every day. Our friends, a lot of them are seeking homes because they have children who are in schools that they would like to keep them in. They have jobs that are based in Los Angeles and they like to stay near that. And it has been difficult. They have been searching for homes that are hard to find already with a housing crisis in Los Angeles. And they're also having to deal with really skyrocketing rents that happened overnight because of the fire, which is very, very unfortunate. So it's difficult. Some of them are having to move further away than they wanted to. Some of them are still at friends' homes and in hotels waiting to find the right spot for them. But it has not been an easy process.
We know that and the process has been compounding in its difficulty. I wonder what aid you have found as you look to rebuild your business.
We have applied. My sister is my business partner as well, and we applied for an SBA loan immediately for our company since we lost everything, and our other mixer line is just really getting off the ground. That is pending. There's a lot of documents that you need to provide. I will say that they are swift in letting you know what is incorrect and that you need to re-upload. We haven't gotten too far yet, but we will keep trying. And that is our main source of what we're looking for relief. We're very fortunate that we had an outpouring of support for our mixer company, which is wonderful. But we know that our friends and family are also reaching out to FEMA and also SBA and other forms of disaster relief. And we're very fortunate that there's been an outpouring of support from local officials, local retailers, local agencies, which is wonderful to see.
Yeah, it's a tremendous effort, and seeing people come together really to have the backs of those who they know and the firsthand or here are affected by these events in California. I wonder, even as you're working through the filings, paperwork, and it's great to hear that you're keeping business in the family as well. What is next for your business?
Continuing to wrap up loose ends with the bartending company. It was heartbreaking to tell our, 142 employees. We had 80 active employees that were, scheduled for upcoming jobs that things were closing immediately. That was heartbreaking. So just wrapping up loose ends then. And then, as I mentioned, just turning our full focus on getting the other company off the ground and supporting it in every way that we can. Our main source of revenue and income was our bartending company. So we are switching quickly and aggressively to get things off the ground in another way.
Jordan, thank you so much for taking the time here, even in this difficult moment, and continuing to wish you and your team and your family the best over there in California and on the West Coast, to everyone that you know that's also impacted.
Thank you, Brad.
Thanks. President Biden announcing California residents affected by the wildfires may be eligible for a one-time payment of $770 from FEMA, the Federal Emergency Management Agency. This is part of FEMA's Serious Needs Assistance Program, which is money received up front to help survivors pay for expenses related to a disaster, such as food, water, baby formula, and other emergency supplies. It's generally available during the first 30 days after a disaster is declared. The time can be extended to 60 days with written request, and to qualify, you'll need to complete a FEMA application online or over the phone. Criteria for assistance includes you or someone in your home is a U.S. citizen, non-citizen, national, or qualified non-citizen. FEMA needs to confirm your identity, your home must be in a declared disaster area, and you live in that home most of the year. You must apply while the program is available, and there must be disaster damage to your home, which is confirmed upon an inspection via documentation. Coming up, the wildfires in LA have destroyed more than 12,000 structures. We're going to talk to an LA-based real estate broker about protections against rent price gouging and other tips to help you navigate this time of uncertainty. Stay tuned. California Governor Gavin Newsom is extending rent gouging protections across Los Angeles County through March 8th, tied to the wildfires. The executive order prohibits rent increases of more than 10%, and the law includes restricting price gouging on hotel and motel rates. This comes after multiple reports of violations, up to 60% increases in Venice and more than 100% in Santa Monica, according to the California Apartment Association. Here with more on the fires and the impact to people's homes is Josh Altman, co-founder of the Altman Brothers team in Los Angeles. Thanks so much for hopping on with us here. We know that this has gotten into a gouging crisis here. What are you continuing to communicate with your own customers and clients as well?
Yeah, I literally just got off the phone with my team. We now have a team meeting every morning trying to put together a list of leases that are available that are not on the market, because if you look on the market, there's not enough available. So we have been digging and digging every night, and every morning we meet and we have a new list so we can see how many people we can place that are currently staying at friends' houses, family, hotels. That's what we're now doing in order to help and to figure this whole thing out. It's a lot. And yes, the price gouging, it's a serious thing. Of course, Santa Monica is going to raise their prices the most. It's the closest to the Palisades. That market is just going to explode. I mean, Brentwood, Bel Air, Beverly Hills, these are all going to be very strong markets. So people who lease can be as close as possible to the jobs they had, to the schools that their kids have gone to. That's really the new norm. But as far as the price gouging goes, you know, there is over a list of 2,000 units that are out there right now that have higher prices than they did have a couple weeks ago, late in December. I'm not surprised to see it because of the supply and the demand. And a lot of people, to be honest with you, that I speak to, aren't even aware of the price gouging law, because if you ask me, I didn't even know about it 3 weeks ago. We haven't dealt with this type of natural disaster. So it's something new that we're trying to navigate through day by day here. Good news is the ordinances are changing, which means that the process is going to be a lot faster to hopefully get these people back to building. But again, that's going to be a whole nother story, because we're seeing leases at a minimum of 2 years with multiple year options, because people are understanding it's probably going to be a 4-year process to get their house rebuilt.
Yeah, Josh, I wonder just briefly if you can quantify, because we heard that California Governor Gavin Newsom, of course, is prohibiting more than a 10% increase and through March 8th. But for the listings that you've seen come online, or listings that were already in existence that have now seen price jumps, I mean, how are you seeing that quantifiably, and what type of percentages are you coming across?
Well, here's the issue. Nothing's going to stop somebody from doing that. In the long run, yeah, of course, they may get in trouble. They may be in a situation where they're going to have to pay back the difference of where they were listed at compared to where they are listed at now when the people move in. But the issue is, you put a house on the market and it's a good lease, or an apartment and it's a good lease, you're still going to get inundated with 50 lease applications. These people are willing to pay for it at the moment, because what is their other option? A lot of them have insurance that are paying for it, which is why the homeowner or landlord that is leasing out the house thinks that it's not a big deal because the insurance is paying for it. So it's yet to be seen what's actually going to happen with all this. Again, I understand it. But of course, people, you know, they got to follow the rules. You can't do this to people who are in this type of situation.
Yeah, I want to get to some tips for LA residents in a moment. But first, you mentioned insurance there, and insurance companies, they have been reportedly reducing some of their coverage in California. We've heard that. It seems like that's heading toward a crisis of its own.
Yeah, so I'm on with my insurance broker every single day. It looks like anybody who was well insured and did the correct paperwork, it's going to be about 90 to 100 days before they see their check. That's for someone who's properly insured. 90% of the people are underinsured. They're not going to get the money back to build the exact property that they were in. Those people are going to have to go to battle with the insurance company. Could be 6 months, could easily be a year. So also what's interesting that we're going to see is different waves of buyers and tenants that are going to be coming through. It's not just the mad dash for the next 3 weeks. You're going to see it again in 3 months. You're going to see it again 3 months after that. And also what's really surprising, and maybe this has to do with the income level of the Palisades. I live about 10 minutes away from there. So that's the area that I'm concentrating on, is Malibu and the Palisades. What is interesting is the amount of people that have just said, you know what? Time to move on. We'll get that check. In the meantime, we're going to go buy a house, because this is going to be 4 years and we need to start our life as soon as possible. So that's interesting.
Okay, just lastly, while we have you here, Josh, and it's good that you're continuing to keep a pulse of all of your clients, having your regular meetings with your team as well. And we appreciate you sharing some of these stories, but some of the tips as well that you might have for people who are looking for shelter, those who might be viewing, or those who have family members that might be viewing and able to pass along some of these tips.
Yeah, definitely call multiple realtors. And this is coming from a realtor. Call 10 of them, call 20 of them, get on the phone. Those are going to be the people that are going to have the pocket listings. If you're waiting to look on things like Zillow or the MLS, it's probably too late. Also, I would say this, and I want to put this out there because I'm doing a lot of interviews. LA, California, it's going to bounce back. We are down right now. We've been through a lot, but we've also been through a lot before. We are LA strong. We will rebuild places like the Palisades, long-term investment wise. I love it. I would put all my money in that area if I could. It will come back. It might not come back with the same homeowners, but it will come back with a lot of new homeowners who are going to start their lives over there again.
Josh, thanks so much for taking the time here and sharing some of your time, especially at such a critical juncture here for LA and for California. We appreciate it.
Thank you for having me.
Certainly. Stay tuned. We've got more Yahoo Finance after the break. The secret to success when investing for retirement may actually be pretty simple, even boring. Carrie Hannon joins us now to explain why passive investing has proven to be a winning strategy. Carrie.
Yeah, hi, Brad. Well, the proof is in the pudding, I like to say. You know, these index funds regularly clobber actively managed mutual funds year after year. Yes, there's a percentage that does with actively managed accounts that do fantastically well. But the bulk of them, you know, roughly 80% or so, outperform, you know, the index fund is outperforming the actively managed fund. So we're talking about the S&P 500 index and broad-based indexes that track a certain basket of stocks or bonds. And so I'm a big fan of index funds for retirement accounts because the costs are lower. Number one, that's a huge point. They're managed by computer. You don't have the active management fees of trading in and out of different securities. They're super simple. And if you can just, balance across a basket of stocks, equities like the S&P 500 index, and some index bond funds, you're set. And when the markets go a little haywire, you don't have to panic. You've got some diversification right there in front of you. And in fact, Warren Buffett has even said, a few years ago in one of the annual meetings at Berkshire, he said, hey, for most people, owning an S&P 500 index is the way to go. It is super simple, and just year after year, they clobber the actively managed funds. Yeah, it's a little boring, but I'd rather go with boring. And the fact is, Brad, most people actually do own index funds, and they're target date-based retirement funds. So say you have a target fund in your 401k plan that you've set, I'm going to 2044, say. That account, that target date retirement fund is made up of index funds. So you're already an index fund investor. But, I just think year after year, we have multiple studies. And I wrote this story just now because 2 new studies have just come out highlighting this actual return thing. So, I think it's worth throwing it out there. It doesn't mean don't invest in other things, but for retirement savers and even retirees, this is a really steady Eddie way to go.
Carrie, thank you so much for breaking this down. Appreciate it.
Thanks.
According to a survey from Yahoo Finance and Marist poll, 47% of Americans say that the cost of living is their biggest obstacle to saving more. Other issues include unexpected expenses and too many financial obligations. If you're looking for a new way to make every dollar count, you may want to consider ditching the strict budget and instead embracing living frugally. Here to explain the frugal living philosophy, we've got Jill Seriani and Jen Smith, co-authors of Buy What You Love Without Going Broke and co-hosts of the Frugal Friends podcast. Great to have you both on with us. So Jen, let's start with you. What is frugality and how is it different than just setting a budget?
Yeah, so frugality often gets a bad rap as being cheap or miserly, definitely not fun. But for us, being frugal is being a good steward of your resources, all of your resources. So that is, of course, your money, but also your time and your physical space, your mental energy. And it benefits you, but not at the expense of other people. So a great example we like to give is fast fashion. We don't get the cheapest shirt possible that's made by potentially slave labor or at the expense of somebody else's well-being. We try to shop sustainably so that it benefits us, but not at the expense of somebody else.
Jill, what are 3 tips to live more frugally?
So it's really important that we look back and understand our current spending. We recommend doing a 90-day transaction inventory, which is gathering your bank statements, your credit card statements all in one place and observing what are my current spending habits? How have I been spending money? Where is my impulse spending happening? And that can inform the changes and shifts that we can then make going forward. The second thing is to identify what you value. And we've identified kind of a good place to start is with the 4 F's. That for most of us, we share these common values of family, friends, faith, and fulfilling work. And where we can increase our engagement in those 4 categories, often without even needing to spend money, and then figure out what we want to be spending on from there. But we can find that our impulse spending can significantly decrease when we're getting more of the things that actually matter to us. And finally, incorporating the habits and behaviors that are going to align our money with those things we said we want more of, and finding alternatives to the impulse spending that we're typically doing, coming up with a dopamine hit list that doesn't involve spending money. Maybe that means that I'm going out for a walk, or I'm going to exercise, or I'm going to spend time with friends, or I'm just going to watch funny videos. All of these things can give us the rush that shopping also gives without hurting our wallets.
Jen, I wonder, what's your advice for anyone who struggles with overspending and perhaps chronically?
Yeah, not to give up with this lifestyle. So often we yo-yo diet with money, and it's because we've learned a lot of our financial consumption from our food consumption. And so we'll go all in on budgeting, and then we break one category and we're like, okay, I'll quit, I'll start again next month. But to really make financial changes and improvements in your life, you have to stick with it. You have to continue to make these little changes, re-enter if you make a mistake and stick with it, because that's where you're going to see these long-term things we talk about financially with retirement and getting a new house or a new car. Those are the things that will be possible only if you continue to stick with it and learn from your mistakes.
Jill, just lastly here, how do you make room for spending on small luxuries? Because I for one, I'm an experienced person. If I'm in a certain city and I hear, one of my favorite bands is in town, I might say, you know what, I'll splurge on that, even if it is an experience economy luxury.
It really is important to be able to spend on the things that are going to be life-giving to us. We don't believe that frugality is about deprivation. And so when we can identify what we value, the things we want to say yes to, it can then be really easy to identify the easy no's, the things that don't actually matter to me, that I don't need to be spending on all the advertisements on Instagram, and I don't need a luxury car, or I don't need all of the most recent skincare products. Instead, I want the concerts with friends, and I want the travel experiences with my family. And we can kind of give and take in that way when we've been able to identify what don't I want to spend money on, so I can feel really confident about the things I am saying yes to.
Great tips and advice. Jill and Jen, thanks so much for taking the time here with us today.
Yeah,
thanks for having us.
Thank you for having us.
Certainly. The Biden administration announced its final round of student loan forgiveness before President-elect Donald Trump takes office on Monday. Biden is clearing over $600 million in debt for more than 4,500 borrowers. Some of that debt will be canceled through the income-based repayment plan, but a big chunk will be for students of DeVry University. Back in 2022, the Department of Education found that the for-profit institution, quote, made widespread substantial misrepresentations about its job placement rates. So 4,100 borrowers who attended DeVry will have their debt forgiven. This is in addition to approximately 1,800 former DeVry students who received forgiveness in 2022. Even with obstacles along the way, like the Supreme Court blocking Biden's plan to deliver wide-scale forgiveness for tens of millions of borrowers, the president will leave office having forgiven $188.8 billion in student debt for 5.3 million borrowers. Coming up, if you're still paying off those holiday gifts, don't despair. We've got steps on how you can pay off your debt and start saving. That's next. A programming note on today's episode of Warrior Money, hosted by former Congressman Patrick Murphy and veteran investor Dan Coons, General Wesley Clark discusses why the best leaders start at the bottom.
I think there's no real substitute for experience. You just have to learn it. And it takes a while. It's not something necessarily that just comes out of a book. And so in my experience, the best generals are those who, or in fact, the only generals who they start at the bottom and they work their way up. And they've seen it all the way through. And I think that's also true in business. The best business leaders I've seen are those who have had their hands on the real thing at the bottom, not those who are shoved into an organization at the top because they're just financial managers, but they're people who really understand the stuff of the business.
You can catch episodes of Warrior Money Fridays, 12:30 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. According to LendingTree, 36% of Americans took on debt this holiday season, racking up an average of nearly $1,200. And if you're one of them, you're not alone. I'm in that bucket as well. But are not sure how to pay it off and start saving? Our next guest is here to help. We've got Ross Mack, host of Financial Freestyle, joining me now in studio. Ross, good to see you. You've got 5 steps in your New Year's financial resolution playbook. The first is to make a budget. So how do you get started on that effort?
Listen, I think when it's all said and done, it's very important to control your inflows and outflows. You got to write it down, which doesn't seem sexy at first, but you got to write it down. You got to know what your annual expenses are, but I actually want to break it down on a monthly. So you want to know, and I always try to bucket it in a 50-30-20 rule, right? When it comes to budgeting, you want to know your wants, your necessities, and obviously investing and saving and paying down debt. And the next step, right, is you have to save $1,000, right? It sounds kind of weird, but 44% of Americans can't cover a $1,000 emergency expense. What happens? Oh, now they have to take on more debt at higher interest rates. And so I think when it comes to that second step, you really want to do that. And then third step, right, is now let's actually focus on paying down that debt. There are a lot of ways, whether it's, saying, okay, do I want to do the debt avalanche method, debt snowball method, or find ways of saying, let me get a 0% APR credit card and kind of roll it over here while still being, disciplined when it comes to paying it down. But now, guess what? You're only paying down that principal. And then so when it comes to the fourth step, now it's like, look, the average American is living paycheck to paycheck, but one thing you want to do is actually have a fully funded emergency fund. I think quite too often you find people, especially, when we lived through COVID, you saw people, if you lose your job, guess what? Now, you're relying on relatives, taking out more debt. And so you want to have a fully funded emergency fund, which I determine as saying 3 to 6 months of your necessary expenses, right? That being whether it's your rent, rent, mortgage, grocery bills, your health bills, et cetera, right? And then lastly, you want to start investing. I think it's very important that you understand you can't save your way to wealth. You have to start investing, right? At a bare minimum, right? You want to find a way to outpace inflation. And so when it's all said and done, you want to do that. I have a actual free financial resolution playbook at ross.maconomics.com.
Just quickly, we only got about 30 seconds left here, but when you think about check-ins along the way, how do you create those conscious check-ins to make sure that you're staying on track and on plan?
Absolutely. Everything starts with the budget, and why I say that is because for every step that I said, it should be budgeted into what you're trying to do on a monthly basis. So if you're trying to get out of debt, guess what? In your necessity, you want to say, okay, I want to put $200 a month to start getting out of my budget. And then the next thing is, okay, I want to put $300 a month after you're finally out of debt, right? To say, okay, I want to start building up my emergency fund. Oh, and more importantly, I now want to budget every month for investing. I think, once you set up auto investing, auto deposits, et cetera, it becomes seamless.
Ross, thanks so much for taking the time here with us today. Everyone, you can catch more of Ross Mack on episodes of Financial Freestyle Mondays at 12 p.m. Eastern Time. Catch them on Yahoo Finance or wherever you get your podcasts. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Guess what? You can stay tuned for Market Domination with Julie Hyman, Josh Lipton. That comes up at 3 p.m. Eastern Time. You don't want to miss it. Here's a look at the U.S. major averages on the way out.